All right, welcome everyone. Today we'll be talking about the basics of investing and also the share market. Let's talk about money. It's good fun. Okay, so this is our agenda today. 7 main topics. So gonna start with why invest, and then I'll talk a bit about the macroeconomic picture right now. Go through some basics when it comes to the share market. Talk about how do you actually get started with some recommendations for platforms that you can look into. And afterwards, I'll talk about portfolio building and diversification, and also talk a bit about alternative assets, precious metals, and a controversial one, Bitcoin. And also at the very end, I'll talk about how I'm currently positioning my own portfolio. Okay. So all my holdings will be reviewed at the end. All right, some disclaimers to start things off. Okay. So this webinar is definitely not financial advice. I want to provide more knowledge so that you can make better decisions for yourself. Always understand the risks before you invest. So very important to note those points. Before making a decision, make sure you consider all the options and also perhaps speak to a financial advisor as well. Cool. So a bit about myself. Name is Hans, so most of you here know me. This is probably quite unknown. Before my sports science days, I completed a Bachelor of Commerce and I actually majored in actuarial studies at Melbourne Uni. And nowadays I'm doing a PhD in exercise science, completely unrelated. It's all pretty random. As a side gig, right now I'm unit coordinating for finance at Deakin College. So just doing something small on the side to keep myself occupied in the finance space. I've invested in the share market for about 9 years. So since about 2012 was when I bought my first shares. I was actually quite late. One of my biggest regrets was not starting early enough. So 9 years ago, I was 2021, so second or third year of uni. I wish I started earlier. And it's also on and off as well. I kind of wish that I paid a bit more attention into this. Only in recent years I got a lot more serious. Yeah, I reckon I'll probably retire by now if I actually took it seriously and properly. So fun facts. In March 2020, I lost almost 40,000. Well, not lost because I didn't sell anything, but my portfolio was down around $40,000 in March 2020. So you might be asking the question, why am I listening to this guy talking? 40,000 down. Okay. All right, so investing is a psychological game. Right, so very often you get a lot of emotions, and emotions make you do stupid things. Okay? And there'll be a time where your investments may give you a borderline heart attack. Okay? You'll be really shocked, and you're like, "Oh no, I'm risking my money. I need to sell everything." Okay? There'll be times where you feel like that, and you can absolutely lose money as well, even if you're doing the right things. So there's a lot of risk involved. We all need to be aware of that. All right, so this is the share market last year in 2020. Okay. So what's happening here is that, so you might recall COVID, this thing called COVID, that started back in around March last year. And that's how the stock market responded. Okay. So in March 2020, the market was down around 30-40%. So whoever was holding any stocks, any investments, you would have lost money. Okay. Well, you would have lost money if you held on for the whole time, but if you sold at bottom, you panicked, then you would have lost a lot of money. Okay, so that's why my portfolio was down 40K. Like it was kind of unavoidable because of that crash. All right, so you can see here from around 7,000 points, or drop all the way down to 4,500. So around 30-40% for the ASX. Okay. So I saw 2 types of people. Okay. First type of people, they panic and sold right at the bottom. Okay, so you can see it all across the online forums. You look back at the post, people were panicking so bad. They were like, let's switch everything to cash. Market's crashing, it's not going to recover soon. Let's sell. Okay? A lot of people sold right in that March area when the market was down. Okay, so those are people that will probably end up telling you that the market is a scam years down the track, right? And there's also a second type of people. So people that bought the dips. Right? So bought in during that time. I guess in hindsight, it's always hard to say, but when market crashes like that, usually it recovers. And I'll talk about why that's the case. Okay. So for myself, I actually bought in big. Okay, so just before the crash, I had a bunch of money, okay, that was lying around doing nothing, right? So I was like, okay, I better do something with it because I'm not getting much in interest in the bank accounts. So I chucked like I can't remember exactly. It was like 50K in the markets around Feb, just before the crash. Okay, so that was a lot of money. That was I was like, yeah, looks like it's gonna keep going up anyway. Okay, I chucked a bunch of money in. Right. So of course the crash happened straight after I chucked the money in. But then I started buying. I bought there, I bought here, I bought here, and I bought at the bottom as well. Okay, so throughout the whole March, I was buying. Okay, and by now, the market, you can see here, by the end of December, end of the year, it's already recovered pretty much. And by now, the market's actually higher than pre-COVID. Okay, so right now, ASX is at all-time highs, and so is many other markets. I think all markets around the world, basically, apart from China, at all their all-time highs. Okay, so pretty crazy stuff. Yeah, which is why you should be cautious. Okay. So yeah, it's quite important for us to understand why we are investing. Okay, so if you invest without much understanding, you quite likely end up being type 1 and you lose a lot of money. Okay, when the market goes down, you fear, you're scared, all right, and then you sell everything because you don't understand why you're investing. Okay, there's no conviction in your investments. Okay, so that's why I want to focus on explaining the why as well, not just the how. Okay, so for some of you that are already investing, you might find this quite boring. But for others that are currently not investing, I think this is important for you to understand. Okay, so yeah, markets are fully recovered by now, and that's mainly thanks to stimulus by the government, which I'll talk about when I talk about the macroeconomy as well. Type 2, people that bought would have done really well for themselves. So a lot of people that bought in, yeah, they would have made a lot of money, okay, during that time. Okay. Right. So money motivation. Why is money important? Okay, see, I'm money hungry. Yeah. So I think recently, past couple of months, I was talking to a friend about investing, and she just said to me, Hans, why are you so money hungry? Why do you love money so much? Right. I think the conversation here came about when we were discussing the merits of investments. Okay, so she thinks that I'm money hungry just because I invest. Right. It's not actually about the money. So money itself is useless, right? It's just a tool. Okay, so money is a tool to achieve these two things, in my opinion. Okay, so first thing is fire. Talk about what that is shortly, and also to make a significant difference, okay, in the world. Okay, so first motivation, fire. So fire stands for financial freedom and retire early. Right, so it's a movement that's gaining popularity in recent times. Okay, so fire means that you can wake up one day and you have the choice to do whatever you want. Okay, so it's basically no pressure, to do something that you hate. Okay. So the various degrees, right? When you don't have enough money, we're all slaves to it. Okay. We all know that. I know some of you are a bit younger, but if you've been working for a while, yeah, maybe you have great jobs, but there's also a lot of jobs out there that are kind of pretty pointless. Okay. Not many people actually find meaning in their jobs. Okay. So imagine that one day you can actually make decisions based on what you truly want to do. Okay. And take note that retiring early doesn't mean that you're unproductive and don't contribute to the society as well. There's a lot of things that you can do. You can volunteer, you can choose a job that you actually love instead of looking at the money. You can start your own business to tell the world your vision. All these things are things that you can do once you are financially free. Okay. Right. Yeah. So, things like when your boss tells you to do unethical things, it happens in a lot of jobs. Okay. You can tell the boss to piss off. You don't do it. You can just quit. Go like, hey, I don't need your money. I can quit. Right. So imagine having that power. I think that's it's quite powerful. Okay. And the second thing is making a difference. Right. So maybe you want to make a real difference in the world. Okay. So real significant difference. I mean, real difference can be made, but when it comes to actual proper significant difference, you need money to achieve that. Okay. Ultimately, if you want to make a difference in larger scale, you need that money. So you can use your money to create a business, to imprint your vision in the world. Invest your money in businesses that you believe are better for the future. Or maybe you choose to donate your money to people in need. Okay, perhaps less fortunate people from poorer nations, or maybe perhaps to your kids, so that they live a more comfortable life going forwards. Okay. And I'm just going to play a quick video by Chamath. Okay, it's not loading for me. Just give me a second. Right. No, please, yeah, there we go. So just a quick video on why money is important.
I mean, you've been outspoken about the Trump administration's position on immigration, on a number, I mean, these things are going to collide in government and business, right? It's happening now.
Yeah.
So what do you want these future business leaders to do about it once they get into that spot?
Get the money. Get the money. And then let's get around a table and let's create new rules. Literally that simple. Get the fucking money. I'm serious. Do not get it. It is going to be made. It is going to be allocated. And you have a moral imperative to make sure that if you have a point of view that matters and you want to reflect it, you get it. I'm going to go get it. Other people are going to go get it. And then it will be about a competition of views. And don't wrap yourself in all this liberal kind of bullshit about oh my God, money, blah. No, stop. Here's how the fucking world works, okay? It drives the world for better or for worse. Economic incentives drive entire swaths of populations to behave in very, very predictable, and then when you take it away, unpredictable ways. Ask anybody in your class that's from a developing nation. Ask anybody in your class who has seen that play out from where they're from. So that's what you have to do. You got to go and get it. If you control the capital and you have a point of view, you can now, then the question is, don't be a sellout. Whatever your worldview is, you should be spending time to think about what that is, so that when you control some of these purse strings, you push that view into the world.
All right, so pretty interesting words by Chamath. I think Chamath is a self-made billionaire. Pretty good guy to follow as well. On Twitter, he has a podcast that I listen to that I'll talk about a bit later on. But yeah, hopefully by now you're convinced of the why. So how can we actually work towards that goal is the question. Okay, and now let's talk a bit about share market, money, and also the wider economy as well. What is the share market? Right, so yeah, when you buy shares, right, it means that you're buying ownership of businesses. If you own 10 out of 1,000 shares in the business, it means that you own 1% of the company. Right? So usually companies on ASX have millions or even billions of shares on issue. Okay? So in buying ownership, essentially. Right? For me, in my opinion, it's a brilliant system that's created to even out the wealth distribution. Okay? So people often argue that the stock market makes inequality worse. Okay? And that the whole capitalism is the disgrace, blah, blah, blah. Okay? I don't quite agree. So yeah, buying shares mean that you gain ownership to businesses that you don't even contribute to. Okay, so all you contributing is your money. Okay? People involved in the operations of the company are doing the work, and you're benefiting in return. Okay, in monetary terms. Okay, so instead of one or few owners benefiting from the business doing well, the love is spread to all the shareholders and to the general public. It allows everyday people like us to access the businesses that we otherwise won't have a chance of owning. Okay, so that's the stock market. Okay. Right, some people call it a voting machine as well. Okay, it basically allows us to cast our votes on investments that we believe in, cast our votes on the future that we want to see. Okay, you put your money where, investments that you think that is going to represent the future. So how do you earn? Okay. There's two ways for you to earn a return when it comes to investing. You can earn via capital gain. Okay, so that's refers to the rise in share price when you sell. And of course, if you sell when the share price drops, then that'll be a capital loss. Okay. There's also dividends. Okay, so dividends are basically just distribution of profits to shareholders. So basically you receive cash to your pockets. Okay, for example, a company might earn 100 million a year. They decide to pay 20 million of dividends to the investors. Okay, that 20 million will come to you depending on how much shares you own. Right? I think though that not all companies distribute dividends, and there's a variety of reasons for this. There might be growth companies that are not generating a profit, or perhaps they rather reinvest the money they earn to grow the company, to get more market share. So it's not necessarily a bad thing that if a company doesn't earn a dividend. Yeah, the power of the share market. Right? So on the right, you see a chart that represents the yearly returns since 1990, 19,000. Okay? Right, so a lot of history. In average, every year, it's 11.8% per annum in return. Of course, you get negative years as well. You can see on the chart here clearly negative years. They happen, but it's only a small portion. So 1/5 of years end up being negative. Okay, but long-term wise, historical data suggests that it works. Okay. So what does that mean for your money? We'll do some calculations. 11.8% return. Right. So let's say that you are a well below average investor. Right? You can't get 11.8% and you can only generate 8% per year. Okay, so you're not very good. Right? You also have very little money, only $100 to start things off. Okay? You can afford to contribute $500 per month. Okay, so $125 per week and $16 per day, right, to your investments. Okay? So assuming that if you're able to earn a reasonable income in Australia, $500 per month of monthly contribution shouldn't be too difficult to meet. Okay? Of course, everyone's financial circumstances are different, and maybe this is me speaking with privilege. So forgive me if that's the case, but I think, for most people, it should be pretty affordable. Okay? So based on these calculations, looking at the calculator on the right, if you do this for 35 years, contribute $500 per month, you'll be a millionaire when you retire. Okay, so I think the end amounts shown here, end balance. Okay. So you have more than $1 million. Right. So of course, in 35 years' time, $1 million might not be a lot, but I guess that's another thing to discuss coming up as well. But you can become a millionaire just by doing that. And I would imagine for most people, once you have a steady job, you'll probably be able to contribute more than that. Okay. Right. All sounds good so far, but of course, there are always going to be concerns. Okay. Stock market, it's risky, right? Can't you lose all your money? Isn't the market very high at the moment? And the market is very, very, very high. Shouldn't we just keep the money safe in the bank? Right, so I'm sure these are questions that have appeared in your head when you think about investments. And that's why we need to talk about the concept of money. Okay, so in finance, there's basic fundamental concepts. Okay, that $1 today is worth more than the same $1 received in the future or tomorrow. Okay. Why? Because we can earn interest in our dollar, and which means that it's always better to receive money earlier than later. Money tends to devalue over time due to a variety of reasons. So what is actually money? Have you actually thought about that question? What is actually money? Okay, so this is a bit of a funky TikTok video. I forgot where I found this, but I'm just gonna play it quickly. So this girl's talking about money.
Okay, so you know what I don't fucking understand? This is what I don't understand. See this? See this? See that? This. This is worth $50? This is worth $5? This is the exact same piece of fucking plastic. This is the same thing. We made up these arbitrary numbers. And then we said, we can't print more or else it'll be worthless. How about just don't let it be worthless? How about just don't tell anybody or just like don't let it happen? We literally made this up. This is a construct we made up. Just don't let it inflate. Just don't. Like people, I get.
All right, you get that point. It's a bit of a silly video.
Okay, so you know what I don't fucking understand?
A silly video, but she actually makes a very good point. Money is just a human construct. Okay, so we typically think of money as currencies. Okay, so we call this fiat money. When we say fiat money, we are talking about currencies that are not backed by any commodities. Yeah, so in the past, before 1970s, money used to be backed by gold, but not anymore. Okay. So when it's not backed, right, it means the authorities can control money. Okay, they can print as much as they want, do whatever with it, right? So currencies, Australian dollar, US dollar, Chinese yuan, etc. All these are currencies. Currencies are controlled by central banks around the world. Okay, so central banks have the choice to increase the money supply as they wish, basically. So you might have heard of the term money printing in media in the recent years. Yeah. So a lot of money printing going on. But what is actually money printing? Okay. So money printing, central banks can basically create money out of thin air. Right? They just create money. Right? They do whatever they want with it. So when they create money out of thin air, they use the money to buy government bonds. So this is known as your quantitative easing, or QE. Okay. So it's a tool from the monetary policy. So when we say monetary policy, we're talking about central banks making decisions when it comes to money. Okay. So it's actually quite a few common misconceptions. So when they say money printing, right, it doesn't mean money flowing into the economy directly. Yeah. So if you look at the chart on the right, yeah, you can see that money printing actually happened. It started quite recently. Okay. In 2008, when the global financial crisis first hit, that's when they first used this tool. You can see before that it's pretty steady increase, quite slow. All of a sudden, it started to pop up. Okay. So in response to GFC, it's quite a new concept that like doing such aggressive money printing. Of course, it keeps going up because they have to keep printing. It drops slightly and then COVID hits and bam, it goes up again. Okay. So yeah, quite likely this is just gonna keep going up. Right. So they can't really stop printing for a variety of reasons that we'll talk about as well. Okay. Right. But anyway, so this money doesn't go straight into the economy. Okay. So money printing, yeah, it's just central banks creating money to buy government bonds. That's all. Okay. Government also needs to spend the money via what we call fiscal policy. But yeah, money printing is what gives the government that firepower to inject money in. Right. So yeah, if you want to read more about this, you can look into modern monetary theory, MMT. That's basically what governments across the world or central banks around the world are attempting to achieve. Okay, it's quite a new concept. Is it going to work long term? Who knows? Okay, some experts say yes, some say no. Maybe, maybe not. But either way, it's quite alarming that we're trying this strategy and we need to be careful of the consequences. Right. So this is Jerome Powell. He's the chairman of the Fed Reserve in the US. Every time he talks, the markets tend to react because his decision makes a lot of difference to your investments. Okay, so that's him. That's a bit of a funny picture of him printing money. Okay. Right. Oh, get rid of this. Okay. So a better measure for to look at is the M2 money supply. So the one that we looked at before is M0. Right, so M2 money supply represents the money that are actually in the economy. Okay, so as you can see here, in the COVID period, 2020, a lot of money was injected in the economy as a response from COVID. Okay. Right, so from this graph, you can tell that a lot of money has been going in. So if you ever wonder why the stock market and property prices went nuts over the past year, it's because of this money printing and also the spending by the government. And so a lot of money flowing into the system, and the money has to go somewhere, and the money end up in asset prices. Okay. So even though the economy is not well, asset prices all-time highs, property prices all-time high. Right. So yeah, just the example. I guess that might be a bit too technical, but just for you to understand. So if there's more money, right, that in the system, let's imagine that there's only $100 in total in the world, and you own $10. Okay. Are you rich? Yeah, you are very rich. You own 10% of the world's wealth. Okay. And then the authorities come in and go like, hey, I'm gonna print out $900 and distribute around the world. And he only gives you one because you're rich, $1. Okay. You now own $11. Okay, so in normal terms, 11 is more than 10. Okay, but are you wealthier? Not really. Cool. Right, so there's 1,000 in total in the world right now. So yeah, you're probably still quite rich, but you're far less wealthy compared to before. You only own 1.1% of the world's wealth. So conclusion of this is that money printing ends up devaluing the money that you hold right now. And $1 is not worth the same as yesterday. Right, and money printing, is it here to stay? In my opinion, absolutely. Okay. If you look at the chart on the right, it's a chart that shows the debt levels by the US government, and the same trend basically across the world. I show the US because they tend to be the most important economy that affects all markets. Okay, so yeah, if debt being so high, money printing has to keep going, otherwise our economy collapse. Okay? And truth is that there's no governments around the world that wants to be blamed for the economy actually collapsing. Okay, so that means that what we call the bubble, you might have heard of people describing the property markets and the stock market as a bubble. It must keep inflating. Okay. What does that mean for you? It means that your money that you hold in your savings accounts are constantly getting devalued at a faster and faster rate. Okay. If you don't generate a decent return on your money is basically what we call dead money. Right? So it's losing value on a daily basis. So just going back to the personal level, how do people actually allocate their money around? How do you budget? Okay. So first of all, you probably pay for your essentials, your rent, your bills, your food, and your beers. Not essentials, and then might be debt repayments, any debt that you owe, maybe mortgages, credit cards, buy now, pay later, whatever you use to finance yourself, and then there's savings and investments. Okay, so anything that's left over is used to either you save it or you invest. Right, so it becomes the question: do you save or do you invest? Right now, the cash rate. So the reason why your interest rates are so low in your banks. I think Lucas is saying that it's getting what, 60 cents. Okay, right? Peace. Yep. Oh yeah. Yeah. So yeah, you're not getting much in your bank at all, and the reason is because your bank's interest rate normally tracks what the central bank sets. Okay, so central bank, apart from printing money, they can also set the cash rate. Okay, cash rate affects how much interest rate you get. So I think over the years, some say they've done well, but for me, that I think it's mismanagement by the central bank over the years. You can see the downtrend. Okay? So you might be surprised. I think it's quite distant memory, but back in 1990s, at one point back in 1990s, the cash rate was at 15% plus. What that means is that you're actually getting 15% interest rate in your bank just by leaving money in your bank. You're getting 15% return. So that used to be the case. I think it's quite insane to imagine, but that is how it is in the past. Okay? You can see that there's a gradual downtrend, and yeah. So nowadays we're getting not much. What kind of rates are we getting? Out of interest. You can see here at the end, the cash rate right now is actually sitting at 0.1%. Okay? What kind of rates are we getting in the bank? Anyone know? Like if you look at your bank account, is anyone aware what kind of rates you're getting? Yeah, all right, Lucas. Lucas knows the tricks. Okay, 0.24% Westpac. Yeah, so Lucas on the chat, he actually pointed out a good point. And for those that are under 30, look into it. So Westpac, that's over 3%. So I actually have an account there as well. Expires soon for me because I'm almost 30. But up to 30K, 18 to 30 years old, if you put money there, and I think you have to use the card 5 times or increase your balance or something, you get 3%. So definitely look into that when it comes to your savings. Look in your bank. Yeah, ING, is it 3%? Yeah, I thought ING was 1.35% anyway. But yeah, ING is one of the high ones. So I'm also with ING. I put some of my money there just so that I can earn slightly higher interest. So, but yeah, the point here is that the interest is basically nothing. You're not getting any return on your money. Cool. So when it comes to savings, right, let's assume that we get 0.05%. So that's actually the rate for the CommBank's net bank saver, I believe. I did that research last year, so maybe I'm slightly high now. I'm not sure. I doubted it. So that's nominal rate. Okay, so it's still positive for now. Okay. But what we want to look at is the real interest rate. Okay, and real interest rate is determined by this equation: the normal rate minus the inflation rate. Okay, so inflation basically just refers to the increase in price of things, okay, stuff that you buy, general cost of living. Okay. Sorry. Right, and looking at this is a report from the Reserve Bank of Australia. Okay, so this is actually an extract from their monthly reports. Okay, you see here highlighted in green they want to aim for inflation rate that's within the 2 to 3% target range. Okay? So the US actually hit 5.4% last month. I think Australia is still quite low, but they're going to aim for it. Okay? What that means is that in order to reach that inflation rate, central banks want to keep the cash rate low, which means that your interest rate is going to stay low in your bank. It's not going to go up. Okay? So you say here, the board is not expecting to increase the cash rate for at least 3 years. Right? So until 2024, at the very earliest, I don't think they'll ever raise it, but at least until 2024, it's going to be 0.05. Okay. It also says here the board will keep the size of the bond purchase program under review. So bond purchase program is referring to the money printing and the QE. Yeah, so banks around the world have made it very clear that they want to keep inflation 2 to 3%. Let's assume that inflation is at 2.5% for the sake of numbers. Okay, just average 2.5%. That's what they achieve. Okay. Your real interest rate equation, you put the numbers in, 0.05% minus 2.5% ends up being negative 2.45%. Right, so that's what you're actually getting from leaving money from your bank. So effectively, you're losing 2.55% every single year if you keep your money savings as cash. Right. So let's do some calculations, assuming that you have $10,000 right now. Okay, so yeah, maybe 1 year is not a big deal of losing that, right? What if time horizon is 10 years, longer time frame? Okay, so if you do some calculations, your 10,000 is actually worth $7,803.20 in real terms, which means that you've lost $2,200 in real value by leaving money in the bank. Okay. Right. So why would anyone accept that? It always shocks me. I think some people kind of know this, but I guess it's a bit hard to make that first step. Okay. So if you leave your cash in your bank accounts over a long term, right? Effectively, it's like you see a cliff that's ahead of you, but you still walk towards it and jump off, right? So yeah, and you bet that in 10 years' time, there'll be a lot more money printed as well, and your money will be worth even less. And inflation could go even higher. It's a bit more than inflation. Okay. So inflation is it's calculated based on CPI, Consumer Price Index. And government frequently revises how they calculate CPI as well. Okay, so the way they calculate CPI is actually very controversial. And for me, I don't think it truly reflects the increase in cost of living. Okay. Right now, for the past 10 years, Australia is fluctuating between 1 to 2% of inflation. I think maybe it's like even less. Okay. That's what they claim, right? That's the official numbers. Okay. Does that sound right to you? Like, do you think your cost of living is only increasing by 1 to 2% per year? Like, what do you guys say? Yes, maybe. It depends on how you spend your money, but yeah, I'm not sure if that figure is overly accurate. Look at some things that we need. Okay, so house prices, it's a good example. Like everyone dreams of probably buying their own house at some point. Okay, look at house prices; it's going crazy. Right, so that's not 1 to 2%. House prices are going up way faster than that. Health insurance, another thing that's basically compulsory in Australia. Right, so looking at the premium, it's also going up like crazy, twice the rate. Okay, it's insane. Okay. And I think house prices are not part of the CPI formula. Right, so yeah, Lucas, $2 to $2.50, that's actually quite a significant increase as well. Okay, 25% increase. And yeah, so prices of things are going up. Cool. And for those that rent, some of you are probably renting right now, and you're thinking like, oh yeah, house prices. Maybe you think of renting for the whole life. It doesn't matter, right? Looking at this street on the right, rent's gonna go up soon. Okay, so usually your rent prices, if you look at this graph here, the green is the house prices, and the black line is the rent prices. Usually rent prices lag a bit behind. Okay, so we know the house prices went crazy over the past year. Rent prices usually follows. Okay, so yeah, for those of you that rent, this is probably not great news. Okay, so yeah, let's say, I think right now we're still in lockdowns. There's a lot of restrictions, so people are not coming in. But once we open up and international people are actually coming in and renting places, expect the rent prices to skyrocket. Okay, so that's what this graph is showing. Okay. Right. So yeah, in reality, I think the true cost of living is actually above the CPI inflation rate. Property prices, health insurance, rent, just two examples. But if you're not beating that rising cost of living, really you're getting poorer and poorer over time. Okay. Yeah. So just watch out the rent prices over the next year or two. I think could be very dangerous. Right. So I've talked about the deflation. I've talked about inflation, right? But there's actually a different perspective out there that addresses deflation as well. Okay, so a lot of economists believe we're actually in deflation, which is a bit funny. Yeah, and they had the points as well, so I thought I should share that alternative perspective. Okay, so why do you think that we might deflate? Okay, debt levels are at record high. So the economy actually grows by debt and credit. So debt has to keep piling up if we are to keep growing. Okay, but a lot of economists are thinking that yeah, debt level will come down at some points, and when it does come down, the economy will probably contract, and that will bring down prices. Okay, so what that means is that companies that have a lot of debt might go bankrupt, and a bunch of economists here, here a few names, they argue for this. Okay, they're like, inflation's bullshit, deflation is what's coming. Okay, and I think this is a good point as well. Okay, so people with this view tend to be very pessimistic about the stock market. All right, so I actually follow this group, Facebook group, and this is a guy named, his name was Baxendale, right? Yeah, so he agrees with this view. He thinks that debt levels are too high and it has to come down. I think he claimed I think from June last year, he was claiming that the stock market is about to crash for like a good 9 months until he gave up at some point. Since last June, the S&P 500, so the US index, was up about 50%. Okay, so I think he was arguing, saying that it's going to crash, but it didn't happen. And tech is also deflationary in nature as well. So important point to note, when technology advancement, it makes it cheaper to produce stuff. Okay, so Kathy Wood, a really famous investor, she's the founder of ARK Invest. Look into her. She does a lot of innovative investments. She takes this view. She thinks that tech is going to contribute to deflation and make things cheaper over time, which makes sense. Okay? So it's a constant battle between inflationary forces and deflationary forces, and that has a lot of implication on markets as well. Okay? So when you get deflation, when you get bad deflation, stock market actually doesn't usually perform well. Okay, so bonds and cash usually actually do well, but yeah, are we gonna get deflation? Probably not. So is it gonna be inflation or deflation? Which one is it gonna be? And it depends on the response by the central bank and the government. Okay, it depends on how much money they are gonna print. Okay, so this is a quote from Lynn Alden, another economist that I have a lot of time for. I think she says some really good stuff, but I'll just get everyone to have a quick read of this quote. Okay. So the end game for the current high debt environment. Right, so a lot of terms that might be a bit hard to understand in this quote, but in layman's terms, okay, so what this quote actually means is just that the government and central banks will not let deflation happen. Okay, and they can do that via money printing and fiscal spending. Okay, they've got tools to ensure deflation doesn't happen. Not ensure, it's always a possibility, but they have tools to try and avoid that situation. Okay. Right, so yeah, for me, I think the governments have made it really clear that that's what they're intending to do. Right, so this is another chart. Okay, so yeah, if you look at the history, whenever debt levels are very high, so last time we have similar debt levels was back in 1940s. Okay, so when debt levels are high, governments tend to print their way out of trouble, okay, or we call it inflate the debt away. Okay, so this chart here shows your bonds minus inflation. So basically, whenever the blue area is below zero, it means that the interest rates for your bank accounts are not keeping up with inflation. Okay, so what that means is that the money in the bank is losing purchasing power. You can see here right now we're deep into negative territory. Okay. Right, so governments have made it very clear by leaving this in negative that they want to incentivize people to invest their money instead of savings. Right? They do that because they want to boost GDP. right? But then there's still people that refuse to participate in investments, even though the government's basically saying, hey, this is what we're going to do. We're going to make your money lose value, but you should invest. Right? But then still a lot of people refuse to do it, right? Which I never understand. Right, there's another article that came out from I think back in August 9. This is on the Australian Financial Review. Okay, so just a quick just read the first paragraph. Okay, so government's borrowing 10 billion to buy stocks. Okay. Yeah, so basically that's it. The government's New South Wales government just decided to borrow $10 billion to inject money to a fund to buy stocks. Okay. Right, so governments are doing this. Governments are buying stocks themselves. Okay, so do you really think the governments would let the market crash when they have invested themselves? Okay, so for me, no way. Okay. So what people don't appreciate enough is that the stock market is heavily manipulated. Okay, it's not really a free market. The governments do things to make sure that it goes up in the long term, and that's why it keeps on going up. Okay. Right. So take on points of this. This is Ray Dalio, another famous investor. He's famous for saying cash is trash, and I agree with him. There's currency devaluation happening constantly. Inflation is a silent risk that you have to watch out for because of how much government spending. And yeah, holding excessive cash in a savings account over the long term is basically financial suicide. Yeah, share market's risky. Yeah, for sure. But it's either that or you accept that your money is deteriorating in value in your savings account. Okay, it's one or the other. So I guess it's really your choice on what to do. Okay, so there's a question on the chat. So who are the government borrowing from? Yeah, that's a good point as well. So the reason why they're printing so much money recently is because they kind of realize that they don't actually owe anyone. Okay, so that's kind of the new view that no governments don't actually owe. So that's why they're happy to increase the debt. Okay, in theory, they're supposed to pay back that debt. Okay, but what we're doing right now, we basically ignore the debt and just keep on going, keep on piling the debt higher and higher. Okay, so I reckon they'll keep on doing that until the system kind of collapses. Yeah, but yeah, I guess to answer that question, Roddy, we're not in debt to anyone. Like governments aren't in debt to anyone. They just create more debts. Yeah, that's more the modern view, the modern monetary theory. A lot of economists hate that. They think that debt should come down, and that's why they argue for the deflation view. Cool. Anyway, so a lot of economics, it's interesting stuff, but yeah, I won't bore you guys too much on that. Enough economics. So how does the share market actually work? Okay, but yeah, hopefully you see the importance now. If you were still doubting about investing before. Okay, so what is the market? Okay, so market is a place where companies list the stocks. Okay, so shares of publicly listed companies can be traded on the stock market. Okay, so in Australia, there's the Australian Stock Exchange, international markets as well, US, Europe, emerging markets, all kind of markets around every country usually have some sort of financial system. The US is by far the biggest. Stocks are also classified in different sectors. Cool. Note that ASX is dominated by banks and mining. So your big four banks and a lot of the mining companies like BHP and Rio Tinto, they represent the majority of your ASX. Not majority, it's the minority, but like they're the biggest by far. Okay. Let's play a quick game. Okay, so which sector do you think performed the best and the worst over the past year? Let me get this up actually. So ASX only. Give me a second. Just let me know via the chat. I'll get the sectors up. So over the past year, ASX is 11 sectors. So companies are classified into these sectors. Someone say cryptos, of course. So crypto is not a sector. Yeah, maybe one day it will be, but I think it's probably part of tech. Yeah, but these are sectors: financial services, materials, which is referring to your mining, healthcare, consumer staples, so things like Woolies. Actually, consumer defensive is that one. Consumer cyclical, small discretionary spending, etc. Yeah, which one do you think performed the best and the worst out of these 11 sectors? Just a quick game. So Radi says healthcare from vaccines. Yeah, healthcare was great. Yeah, so a lot of tech. So note that this is the past 12 months. Okay, so past 12 months, August last year, we already passed the lowest of the pandemic. Real estate down, right? Thanks, Eddie, ETech. Step out and came back. Yeah, so a lot of people are saying tech, healthcare, etc. Real estate bad. Yeah, so let's have a look. So utilities. So this is actually the worst sector. It's down 18.76%. Utilities tend to do well in defensive markets, but not so much in a bull market, which we are currently in. Markets are doing well. There's your telecommunications, so things like Telstra, up quite a bit. Okay. Materials and mining doing pretty well as well, 20.73%. IT, technology, 34.05. So yeah, of course they outperform. If you look back even further, you go back all the way till March, tech would have performed the best. I don't think they're the best in the past 12 months, but they're definitely up there. Okay, so IT, and it's probably a trend that will continue. Bloody tech. Real estate also doing pretty well. Industrials. So airlines is also part of that, I believe. Healthcare actually didn't do so well. Okay, so 10.75%. A lot of you guessed healthcare. The reason why it didn't do so well is because a lot of the gains happened earlier on. Yep. So COVID, what happened March 2020, right? Roughly there. Okay, so markets tend to be forward looking. A lot of people thought of healthcare being a great investment. So the prices actually boosted a lot around March 2020. Okay, so by the time it got to August, it's already quite high, and that's why the return's not as good as other sectors. Still pretty decent. And then you got your financials. Financials actually might be the best, 37.84%. But they did start on low base. Okay, so a lot of banks were trading very, very low around this time last year. And that's why, yeah, they outperform. So buy the dip. Energy, not so well, 1.82%. And then consumer staples, 5%. So these are your like your Woolies. Again, those stocks tend to they did well during the crash, but not so much in the rebound. And then consumer discretionary, that's also really high. So this is more referring to your discretionary spending. So things that you don't have to have, but that you might buy. So things like candles, okay, that you don't really need, but you might buy as a luxury gift. So these are 11 sectors, and that's their performance. Consumer discretionary, tech, and I think financials were the best over the past 12 months or so, which is interesting. All right, let's go back to this. Okay. All right, so how to get into the stock market? Okay, so several options. You can buy individual stocks. You can buy exchange traded funds or ETFs. You can buy listed investment companies. And so today we're going to focus on the first two. Okay, the first two, that's probably the easiest nowadays to purchase. Okay. And yeah, we talked about the risks, and that's why it's important for us to learn about diversification as well. Okay, so it's probably a concept that you would have heard of at some points. Okay, so it's a fundamental investment concept. Okay, what it is that it refers to spreading your investments to reduce the risk. Okay, so if you put all your money in one stock and the company goes bankrupt, you basically lose all your money. Right, so it's important for you to have a diversified portfolio, and the question is how to do so. So how to diversify? So you need to diversify across several things. Sectors, so we saw 11 sectors before. All right, so a lot of people think that tech is the future. Let's just buy all tech. Okay, so I wouldn't really recommend that. I think tech is very good. I have a large proportion of portfolio in tech. But if you buy all tech, you are, it could be dangerous. Okay, so back in the top right image, back in 2000s, okay, so this is famously known as the dot-com bubble back in 2000s. You can see here at 2000, the year 2000, it peaked at around 4,963. Okay, so that means if you bought then, okay, there was a lot of euphoria then. Everyone loves buying tech. Okay, who doesn't? If you bought then, right? If you bought like right at the peak, it would have taken you 15 years. Okay, if you look at the graph here, 15 years until 2015 or so, before you regain that money, regain the value. I mean, you might still earn some dividends in between, but in terms of the pure valuation, you have to wait 15 years to regain that money. So that is quite dangerous. And that's why I say don't just buy all tech. I know some people love it, but be really careful. Right now, tech valuations are insane. Is it going to continue? Probably, but just be careful. It's very high. You got to diversify by countries as well. Okay, so countries can suffer debt crisis. So many are speculating that US might be really close to one. I don't think so, but probably still quite a while away. But with the way that they're printing, maybe one day they'll lose their reserve currency status, and they could be in trouble. The US tends to be the best market, but sometimes things can go wrong as well. Cool. China, over the past month or so, also crashed a lot because of the Chinese government's policies. I think you may have read on the news, they started restricting a lot of the free market stuff. Some of the education companies dropped like 97%. I think they said that you guys can't be profitable. You have to be non-profits. That's like the rule that they make. So yeah, with governments like that are basically they have all the authority, right? So they can do whatever they want, and that's why it's sometimes a bit risky to invest in those places. I think they'll do well in the long term, but you gotta be really careful as well. And that's why you don't put all your money in one country. You also want to diversify across asset classes as well. So far we've talked about stocks. There's also bonds out there. There's also precious metals, gold, silver, platinum. There's cryptocurrency, Bitcoin, Ethereum, etc. You should be owning all this, and of course, property as well. That's what Australians love best. Okay, right. And yeah, cash I think is the last one. Like you still have to have some cash. Okay? You want to spread your money across all these asset classes. Okay. Yeah, so Lucas made a good point. Diversification ETFs less risky. So when you buy ETFs, right, usually they're already diversified for you, and that's why I think ETFs is great, especially for people that don't want to think too much about the investments. Okay, which we'll cover coming up. Right, but although I say that diversification is great, there's also, just like every other thing, there's other perspectives as well. Okay, so this is Warren Buffett, all right, the most famous investor of all time, and that's his quote. Why diversification is only required when investors do not understand what they're doing. Okay, right, and that's another quote. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Okay, there's also Bill Ackman, another pretty famous investor. Diversification is for the lazy. He quotes like that. They're not wrong. Okay, but these are two top investors that we're talking about. Okay, right, the top investors have all the experience. They have insider goss that we don't get access to. Okay, so it's a lot easier for them to outperform the markets than us. Okay. All right, so buying individual stocks. Okay, so rocket emoji, gotta have that. So what are some pros and cons? Okay, so some pros of why you want to buy stocks is that potentially great returns. Okay, so if you pick the right companies and beat the market, you can do better than just getting the market return. Can become a hobby as well. So it's something that occupies my life quite a bit. I quite enjoy doing it. If you enjoy picking stocks, if you enjoy being right, then it could be something that's a bit of fun. Okay. You can also pick actual companies that fit your values. Sometimes when you buy ETFs, right, it includes companies that are not exactly ethical. If you don't want to put your money there, then just pick companies that are actually doing the right things. There's also cons. Okay, it's risky because stocks can go to zero. Pros don't always get it right. Okay, so a lot of pros, if you look at the performance of a lot of managed funds, they actually do worse than the market. Okay, so I think in the past year, a lot of funds were quite conservative, and as a result, they end up doing way worse than the market. So pros don't always beat the market as well. Okay, it's also very time consuming to be tracking a stock. So yeah, it's not for everyone unless you have that interest. Okay. But how do you know what to buy? There's so many stocks. In ASX, there's 2,295 companies at the moment listed. What did I choose? There's so many, right? There's also a lot of options overseas as well. Okay, how do you actually choose what to buy? That's the daunting bit that I think a lot of people are scared of. Right, the truth is that when it comes to stock values, everyone has different approaches to how they evaluate a stock, and that's why prices fluctuate so much. It's an opinion game, right? Okay. Right. ETAC, I'll cover that towards the end, I think, the proportion of portfolio. Yeah, so when it comes to stock evaluation, there's 100 things that you can look for, maybe even thousands. Okay, so you can look at the fundamentals of the company, the future prospects, and you might want to approach it via technical analysis by looking at their chart patterns as well. And so I'll briefly talk about all this. What is a stock actually worth? Okay, so back to the very, very basics. Okay, this might be a bit of maths involved that might be a little bit confusing, but I'll try and explain this well. So when you calculate the price or the value of a stock, right, the basic is back to discounted future cash flows. Okay. So let's say, hypothetically speaking, a stock promises to pay dividends for 4 years. Okay, so year 1, $10, year 2, $20, year 3, $30, and year 4, $40. And after that, they dissolve, they shut the business. Okay, that's all the cash flow that you're getting, right? And we can assume a discount rate of 5% per annum. Okay, remember, the value of money tends to depreciate over time, and that's why we're discounting. Okay, so we apply those calculations, do some maths. This is how you do it. Every year, 5%. The stock value is currently worth $86.49. Okay, so that's how you value a stock. That's the very, very basic. Cool. All right. Right. So the issue here is that it's very, very difficult to predict what kind of dividends a stock will pay in the future. Okay, so a lot of stocks don't even pay dividends. Okay, so how are you supposed to calculate that discounted cash flow? Right, and that's why analysts very often disagree with each other about a particular stock, a value of a stock. Okay, some say it's a buy, some say it's a sell. We don't know for sure because they're all making future predictions, essentially. Right, and just an extra point, if you're wondering why the stock market is so expensive right now, and it's because the discount rate that we use, in the previous slide, we used the example of 5%, but the discount rate that we use nowadays to value stocks is very low. Okay, why is it so low? It's because investors are happy to accept lower returns over time because of the low interest rates. Okay, so keeping interest rate lows tends to inflate asset prices. Okay, because if you change that discount rate, instead of 5%, we say 1%. Okay. All right. If you say 1%, that means the stock value right now is actually $97.06 as opposed to $86 that we got from the previous slide. Okay, so the lower the discount rate, the higher the valuation. Okay. So why are we accepting that discount rate? It's because we're not getting return elsewhere, right? Like you're getting nothing from your bank account. You're forced to invest almost. And that's why we are happy to accept lower returns and still buy stocks. Cool. Okay. But yeah, one thing to note is that what that means is that if the interest rate does rise at some point, okay, I think it's going to be very distant in the future, then the discount rate that we use will be higher, and that can depress your stock market valuations. But that's also one of the reasons why governments can't, the central banks can't rise that interest rate, because as soon as they increase that interest rate, assets are going to collapse. Okay. So I don't think they can. And so you should be pretty safe here, but who knows? They might spring a surprise and raise the interest rates sooner than we expected. It could definitely could happen as well. They basically, they're the ones that make the decision, but I don't think they will because that's going to collapse the markets and no one's going to be happy. Cool. Right. So some easier things to look at when it comes to analyzing a stock. What sector does it belong to? Okay. Does the sector have tailwinds that will push the stock to do well? Okay, so for example, recently there's a huge push towards electrical vehicles and green energy because of the climate change issue. So a lot of money has been flooding into those areas. So you bought in last year, bought in early, then you have done pretty well. Cool. There's also traditional metrics. So things like price earnings ratio, dividend yields, etc. That shows the price earnings is basically the price of the share divided by how much money the company is making. Okay, so that ratio tells a bit of a story of the value of that stock as well. There's also dividend yields. How much dividends you're paying, the company is paying every year. So 3% means that you get 3% of your money back basically every single year. Cool. You can also look at directors buying and selling. And this is the interesting one. Okay, and I'll quickly show you how I can find that. Okay, so when we say directors buying or selling, right? So what we're saying here is basically directors, they work for the company. They're in charge of the operations of the company, but they can also own shares just like you. Okay, so if they buy more shares, usually it's a good sign that they think the company is going to do well. Okay, they're putting their own money into the company, right? But if they're selling, it's the other way around. Cool. But sometimes people can sell for a variety of reasons. So you can't just look at this metric, but it's one thing that you can look at. And I'll show you an example of something that's one of the stocks that that did pretty well for myself. Cool. So this is LCDN Group. It's a marketindex.com.au is a pretty good resource. LCDN Group, I actually bought this last year. I bought around 0.13, I think, sometime like around here. Yeah, so I've been following the stock for a while, okay, but I wasn't sure if I want to pull the trigger. I quite like what they're doing. It's a biotech company. It's a health tech company. So anyway, so I noticed that as I track them, so last year around where is it? So Kate Doyle, she's one of the directors in the company. She bought some shares in the last year. Let's see. Yeah, I think the one I was looking at. Let's see. Yes, towards the end of last year, she bought in at that price point. Okay, she bought like 0.13. That's right. Yeah. So she bought pretty big of her own money. Okay, so when I saw that happening, I'm like, oh yeah, directors trust the company. She's putting her own fortune into it. It's probably a good sign. Okay, so I ended up buying in at the same price as well. And yeah, you can see here the stock went up 3 times over the past year. It's doing pretty well. There's also A2 Milk. So some of you may have come across A2 Milk in your local supermarkets. They've been struggling. So they were doing really well until mid last year, and this crash basically went to the bottom. Okay, mainly to do with the trades with China. Okay, so that was the main issue here. But if you look at the charts, right? If you look at the directed buying and selling, yeah. So throughout the whole, basically leading up, right? Leading up to leading up to that crash, you see a lot of directors are selling. Okay, so all these are telling me that they are trying to take money away from the company, and maybe the company valuation is getting a bit too high. Okay, so these are some things that you can look at, but remember that it's not always the gospel. I can also look at shorts sold. So when it comes to shorts, there's a website called shopman.com.au where you can see the percentage of shorter stocks. Okay, percentage of shares that's shorted in the company. Okay, so when we say shorted, it's basically investors betting against the company. They are selling right now and they're hoping to buy back at a lower price. Okay, so look at this here. These are some of the companies that has the highest short. So when they're high short, you have to be a bit careful as well, because obviously a lot of people think that the company's going to go down. Right, so actually hold some of these. High shorts doesn't necessarily mean that it's bad. It just means that a lot of people think that it's going to go bad. But if they're wrong and you're right for buying the stock, then because shorts, right, once they sell, they have to buy back at some point. So usually share price, if the company happens to do well, the share price is going to boom big time. Right? If all the shorters have to buy back, because they got to buy back at higher prices as well to avoid losses. Okay? So this is a website they track, just to take note. Interesting, SelfWealth might be a company that a lot of people are familiar with. I actually hold SelfWealth, and it's quite high, and it's a little bit scary, but I still believe in it. So some questions. Yeah, I think that directors have to disclose all this information, so it's always public. Yeah, so directors always have to see it. So at this point, so all companies have this. I usually go to marketindex.com.au because it's easiest for me. I find it quite obvious, but anytime director buy or sell, they have to disclose it. And even what's exercise when director does it? So good point as well. Neve, are you talking about these comments, the notes? Yeah, so you want to look for the one that says on market trade. So on market trade means that they're buying on market, but sometimes they might be issued of securities, or I think in 18 million might be exercise of options. Yeah, so these are a little bit different. So when I say exercise of options, options means that the director owns the option to buy the stock in the future at an agreed price. So here, when David bought at 0.63, it basically just means that he owned a bunch of options when the company is really cheap. Yeah, but these are usually not the ones that you look for. You look for the on-market trade ones. Cool. So on-market trades or off-market trades, these are the ones that you want to look for to find out whether the director is buying or selling. So you look at that too. That's additional bit of information that you can consider. let's go back to the slides. There's also trading volume. Okay, so usually if the stock price is going up and it's on a high trading volume, it's a good sign. But if the stock is going down on a high trading volume, there's a bad sign. Okay, so trading volume, again, usually they're just bars in charts. Okay, so if you look at this chart, 80 mil, for example, these are trading volume underneath. Okay. Right, so you can see here, green usually means it's up and red is down. So looking at this is actually looking, looks like it's a bit of a rebound. A lot of people bought in on August 16th. Right, so that's how much shares are traded essentially. That's another metric that you can use. But yeah, there's a lot more indicators out there, and I think we'll probably leave the indicators at that. I'm going to talk about charting at some point as well. I think there's a slide for it. But yeah, warning alert. Okay. So very often you see articles published recommending stocks. You see videos up there recommending stocks. So stock tips and broker recommendations, they tend to be hit and miss. Okay, so read with caution. Right? They can have hidden agendas, or maybe they simply got it wrong. Yeah. So when you think about it, right? Why do they recommend a stock? Why does someone recommend a stock? They recommend a stock because they've already bought in at lower prices, probably. That's why they're recommending it. All right. So brokers always do this sneaky thing. They buy a stock and then they start a media campaign to convince the mom and dad investors to buy the stock. And if they do buy in, then the prices go up and then they sell. Okay, pump the prices up, exactly. So gotta be really careful with those recommendations. I probably wouldn't take those. I'll just read it and go like, okay, don't just follow that. I think when I first started investing, I was following all this advice, and I guess that's how I find out. But yeah, you might do your research, and surprises can happen as well. Okay, so manage that risk. So interesting example. I'm going to talk about two stocks now. The first one is Tesla. Okay, so Tesla is a US listed stock ran by our good friend Elon Musk. I'm sure a lot of people are quite familiar with this. Tesla, a very good company, and Elon is someone that I really respect as well. Okay, but yeah, Tesla over the past year, it's a hotly debated stock, and this is why. Okay. Right, so experts usually either love it or hate it. Looking at the past year performance, so that's what Tesla did. Okay, right, so they've gone nuts. Okay? If you bought in Tesla around the start of 2020, they've gone absolutely nuts. You would have made like 8-9 times return, maybe more than that. Yeah, more than that actually, 10, 12, 15 times. Okay, right, it's crazy. Okay, so Tesla is a very interesting stock to talk about. Okay, a lot of people think that it's too high, but a lot of people are like, I love Elon, I'm going to buy this. Okay. So let's talk about Tesla. Tesla, know that they're not paying dividends. Okay, so dividend yield you can see here has nothing. They're not paying any dividend. Cool. The price earning ratio is at 375.01. You can see here on the charts where mouse is, that's the price earnings. Okay. All right, so that means the price is 375 times greater than what they're earning at the moment. Cool. Just for perspective, usually most stocks average around 15 to 25 in their PE ratios. So this is ridiculously high. Tech stocks tend to be higher. So a lot of tech stocks, because people invest for the future, tech stocks tend to have PEs that's like maybe like 40, 50, 60. And that's quite normal, but not 375. That's insane. Okay. Right. So why is it going up so much despite the ridiculous PE? It's because people buy it for the future. Okay. So is this a bubble? If you look at traditional metrics, yes. But can this bubble keep going? Probably yes too. So that's the interesting thing about stocks. It's a high huge risk buying these levels. I know my dad bought in 650. He loved Elon as well. But it's definitely a huge risk. Okay, so will Tesla go up or go down? Okay, so bull or bear. When we say bull, we mean we are optimistic about the share price. It's going to go up, bull market. Bear, we mean that we are pessimistic about the share price. Okay. So bull case. Why is it bull? Because Elon Musk is a genius. He's a great guy. He's doing a lot of stuff. Like people, he's polarizing. A lot of people don't like him, but I think he's doing good for the world. So it's great. He's a genius. Okay. So I haven't looked into detail about the tech, but from the videos I watch about Tesla, people love Tesla. Like people like Kathy would that famous innovation investor. She claims that Tesla's technology is so advanced that no one's ever going to catch up. Okay, she's also a big supporter of Tesla. Right? Tesla's also built a fan base. Okay, so always going to be people that wants to own Tesla. Okay, people love Tesla. Yeah. And that means that every time the price drops, people might buy in because yeah, they would just want to be Tesla owners. They just want to hold their shares. Okay. Well, the bear case. Okay. Why don't you go down? So Elon Musk, again, back to him. What if something happens to him? You know, maybe some kind of accidents, fingers crossed, no, but then, you know, things can happen. Okay. What if Elon struggles? Okay. What if he decides that he's done too much? He wants to just have no more motivation. I doubt it, but yeah, he could have health issues. Okay. If Elon goes down, Tesla goes down. As simple as that. And you also can't justify the permanent price by traditional metrics. Okay, which means that if the share price does go down, it's easy for people to say like, hey, the metrics are ridiculous, let's sell. It's too high right now. Okay. And also, yeah, maybe there'll be competition that catches up. So electric vehicles have a lot of people looking into it, a lot of people doing research, a lot of companies from overseas as well. So maybe they'll catch up, and yeah, who knows. And finally, more related to economics, if inflation does happen, what that means is that bond yields could go up. So I won't expand too much on this, but essentially, if inflation does happen, you might end up having a higher discount rate. Remember this discount rate example that we looked at? So instead of 1% or 5%, we might be looking at higher than that. And if that happens, that reduces the valuation, especially for stocks like this. Okay, so these are risk factors when it comes to Tesla. Okay, in growth stocks in general, I think tends to face this last point. Cool. All right, second example, Qantas. Okay, so Qantas is a company that most of us should be quite familiar with. Okay, so we all know Qantas pretty well. It's our number one airline in Australia. Okay, so note that Qantas derives most of the income from domestic flights. So international flights actually don't matter too much. Okay, as long as domestic flight resume, Qantas was going to do okay. I think that was like 85% of their income comes from domestic flights. Okay. I'm showing you this because it's a really good example of how stocks actually trade. Okay, so stock prices is all about the sentiments, okay, and also expectation versus reality as well. Okay, so it's all about I think that sentiment is a really important word. And let's have a look at the charts. Okay, so this is a Qantas chart. Okay, so Qantas prices throughout last year up until this point. Okay, right. So I'm comparing this to Melbourne lockdowns because I think last year it was only Victoria, right, that was locking down by mid-year. I think everywhere else in Australia is doing pretty well. Anyway, so yeah, Melbourne being a pretty important city in Australia, Victorian locking down is going to affect Qantas's profits. Okay, so there's 4 key points I would talk about. Okay, so first, early Jan, that's when COVID stories start leaking from China. Okay, that's when the stocks start going down. So you can see a massive crash, and then it reached bottom right when the lockdown started. Okay, it started to recover, and then it peaked again around June 2020, and then finally in early August it went down again. Okay, so let's talk about these 4 points. Okay, these 4 time points. Right. Okay, so early Jan. Right, so that's when we start hearing COVID stories leaking from China. Like news is saying like, oh yeah, there's like a pretty deadly virus coming up. And I think most people are like, whatever, we'll be fine. It's not gonna come to us, right? I think that's probably the general vibe. Okay. But yeah, you see in Jan 2020, the share price already started to drop because investors that follow the news, they sense a potential risk factor in COVID, and they already start selling down, right? But in terms of consensus expectation, I don't think anyone expected us to be in such dire circumstances. No one expected us to be in lockdowns for that long. Okay, so the reality here is much worse than the consensus expectation, right? And that's why the stock kept dropping. Cool. But yeah, good investors would have sensed that risk and already sold out at that peak. That happened in Jan 2020 when no one was thinking about that. Cool. On March 2020, okay, so that's when your lockdown restrictions started. If you remember, I think late March, that's when Dan Andrews started making all those lockdown restrictions. Okay, but even though that's when your economy stopped functioning, that's actually also when the share price bottomed. if you remember the chart, March 2020 was, when the lockdown restrictions started, that's when the share price hit the lows. Okay, what that means is that it's too late for you to sell if you wait until lockdown restrictions started. Okay? If you sold in March 2020, you would have made a massive loss in your money. Okay, but yeah, why did the share price bottom then? Why did the share price keep going up, even though why did the share price rebound at the end of March? That's the question, right? And that's because the reality has already sunk in. Okay, so people are always forward looking. By end of March, we all know what's happening. We all know lockdown's coming. We all know Qantas is going to struggle. If you sold then, it's already too late. Okay. And then fast forward to June 2020. So Victoria's out of lockdown. Okay. But funnily enough, even though Victoria's out of lockdown, I think we went out of lockdown like end of May, like sometime mid-May. But yeah, June 2020, that's when the share price peaked. Again, like it had a mini peak. Okay. And then it started to drop again. Okay. But we're out of lockdown, right? Why is it dropping? And that's because in June 2020, I think most people thought that the nightmare was close to being over and there won't be a future lockdown. Okay. But as it turned out, it wasn't the case. That's why the share price dropped even more, because the reality was, again, worse than the consensus expectation. Okay. So it's all about the reality versus expectation here. And then fast forward to early August, that's when Victoria was in full lockdown mode. The share price has already bottomed and started to go up again. You would have thought that, oh yeah, lockdown for another 2 months, right? The cases were like 700 cases. We're never going to get out of this. That's what have been the thinking. But no, share price actually bottomed then and started to go up. Why is that the case? It's because, again, reality has already sunk in, similar to March 2020. Okay. All right, so where to from now? Now, a lot of people that I've talked to are interested in buying into Qantas. Okay, at these prices, because they think that things will get better. Okay, correct me if I'm wrong, but I think the consensus expectation is that once the vaccination rates are up by the end of 2022, that our restrictions are going to lift, and then we at least we're probably not going to get international travel, but we're going to get domestic travel. Do we all agree? No, it's just my view, but maybe it's not a consensus. But yeah, we reckon, right? By end of 2021, sorry. But by start of 2022, we're probably going to be able to travel, at least domestically. Okay, once we achieve maybe 80% vaccination rates, okay? And that means Qantas can earn money again, because flights are happening, people are traveling. Cool. But the big question here is that because that's our expectation, right? But what will actually happen? Okay. So are we actually going to open up? Or are we not? Okay. So if domestic travel resumes as we expect, then share price will probably gradually go up and back to normal levels eventually. But if the restrictions end up continuing to 2022, sorry, I'm messing up the years here. This is meant to say 2022. If we get more and more restrictions, if by next year we're still locking down and we still can't travel, then share price will probably fall or stay depressed. They might fall because people are like, oh, we thought Qantas will be earning money by now, but it's not the case, and that's why they'll sell out. Okay, so again, it's all about the expectations and what will happen in reality. It's hard to say. Some key take-home points from Qantas. So expectation is always baked into a current share price. Okay, so it's something that I think one of my friends told me, we talked about stocks in April last year, and he was like, oh yeah, I think it'd be a good time to buy into healthcare and buy into COVID-related stocks. And then I'm like, mate, it's too late. April 2020, everyone knows, everyone would have bought in earlier than you. Okay, so yeah, so expectation always baked in the current share price. They're always going to look forwards and predict what will happen. So market reacts to news very fast. If the reality exceeds expectation, if it's better than expectation, the share price rises. If it's the other way around, the share price drops. Okay. So if you sell when it's blatantly obvious that things are at their most grim, you probably sell at the bottom. And unfortunately, I think last year, a lot of people were scared that Qantas is going to collapse, and it sold right at the bottom. I mean, it's a legit fear, but being the biggest airline, they were always going to get support from the government. Okay. And buying when things are at their best would likely mean that you buy right at the very top. Okay. And that means you buy at peak prices. And yeah, that will not be a good investment decision as a whole. All right. And yeah, so this is the quote by the great Warren Buffett. Be fearful when others are greedy, and also be greedy when others are fearful. If this is stuff that you really believe in, if you think that they're absolutely going to be the future, right? When the stock prices are down and when everyone hates that stock, that's when you want to get in and buy. Okay. Cool. Yeah, just a pretty interesting graph that I compiled. So stock market actually outperformed in every 2021 lockdown so far. So let's put this together yesterday. I was just interested because I've noticed that stock market tends to go up every time lockdown happens. Okay, so you can see here, the column to focus on is the annualized return. Okay, so 2021 lockdowns, right? I think this one's not too good, but these 4 lockdowns, right? It's crazy returns, way higher than market, than what the market normally returns. Okay, so every time lockdown happens, stocks go up, which is pretty interesting. You would have think it'd be the opposite, but not really the case. There's 3 reasons. It's because people have nothing to do, right? So they just stay home and buy stocks. It's actually true. Okay? There's also government support and the fact that reality can't be any worse. So by the time lockdowns announced, the reality is baked in already. So start of lockdowns is usually when the share price is most depressed. Okay. So the joke that I tend to tell people is that Dan Andrews is always busy buying stocks before announcing every lockdown, and that's why announcements usually come in the afternoon. So it's just a bit of a joke. Yeah, so maybe that's why it's locking us down. Who knows? All right, so we'll talk about FOMO as well. So fear of missing out. I just realized it's 7:30. I can't keep talking. But yeah, maybe we'll do a break soon, but I'll find a place to pause. Okay. So fear of missing out, FOMO. Okay. So it's a common thing in the investing world. So FOMO refers to the fear that an investor feels when they're missing out on potentially lucrative investments or trading opportunity. I think that's the official definition. Okay. So yeah, you fear that you are not getting into investment, that you're missing out. Okay. So usually it's the strongest when the stock price are surging. Cool. Everyone's pushing for you to buy. Professionals, you've got the forums on Facebook, your friends are all telling you, hey, buy this, buy this, buy this. It's going to go up. Okay. And then you go like, oh no, I'm going to miss out if I don't buy into this. And then you buy it. Right. So yeah, it's very difficult to avoid that emotion. But take note that if everyone is pumping a stock, right, it's a sign that everyone has already bought in, which means that the share price can only fall. Okay. So every time you hear everyone telling you to buy, that's when you should be really careful. It can keep going up maybe, but be really careful in those situations. And I'm certainly guilty of that myself as well. And I'll share some mistakes that I've made towards the end of this presentation. All right, so this is a good graph that shows how the investment works. Okay, you can see here, yeah, whenever we are at that euphoria stage, everyone loves taking on risks. Okay, so yeah, usually people buy, when it dips a little bit. And yeah, people think that they're missing out. Okay, but what happens is that yeah, actually it keeps on going down. Okay, all right, so it gets to a point where you're losing most of your money, and you're like, oh shit, like, no, I need to sell, otherwise I'm gonna go broke. Okay, and you sell pretty close to the bottom, and then you get depressed. Well, actually, you probably feel pretty proud of yourself. You're like, oh yeah, stocks gotta keep going down, and that's usually the point that you should be buying. Okay, but you won't buy because you don't trust the stock market again. Okay, so you might have heard people saying that, okay, market's a scam. Right? I always come across these people saying that it's a scam, blah blah. Don't invest. I'm like, dude, yeah, they must have gone through this. Okay, that's the only explanation I can come up with. Cool, but yeah, people tend to avoid the stock market then because they think that prices are going to go down. But that's actually when you should be buying. Okay, just like March 2020. Right. And yeah, this is lithium last week. Okay, so lithium is a very important metal in building batteries that's useful for your electrical vehicles. Okay, so lithium last week, I basically just went up on Facebook earlier today and just had a look at the forums. One of the groups I followed. So it's one of the posts. Lithium's going to be a flavor of the month. Lithium going to be the first lithium supplier. European lithium boom. Yeah, JP Morgan said buy everything in lithium. Lithium run today. Yes, yeah, this one is a good one. Lithium buy everything. Lithium, come on, lithium pump on Monday. Okay, so whenever you see all these posts on social media, it means that the poster has already bought in. Okay, so they're trying to get everyone to buy so that it keeps pumping. Okay, so lithium went on a crazy run over the past couple of weeks. It's done really well. I think long term is good, but buying end of last week would have been probably quite a poor financial choice. Okay, and of course lithium today. So SYA is one of the lithium miners. This guy posted lithium SYA is falling off the cliff. Do you own more? Yeah. So yeah, today I think lithium retraced pretty dramatically. I think most stocks fall like some of the smaller stocks fall like 10%, 20%, and then the bigger miners also fall like 5% or so. Okay, so if you have listened to all those advice that I just showed you here last week, so all these are posted like mid last week to I think August 9th, yeah. So start of last week and mid last week, all this post came across. If you listen to the advice and bought, then you would have lost a lot of money. Okay. All right, so need to be really careful the FOMO, and that's what that's what people do to emotions. Yeah. All right, so how do you reduce risk? So how do you avoid that? First of all, avoid buying at the peak. Like try to avoid FOMO as much as you can. There's also ways for you to reduce risk in your holdings as well. Okay? You want to buy stocks that have low or little correlation with each other. Okay, they're not in the same sector. They don't really relate to each other. Okay, so when we say high correlation, it means that if one goes down, the other will probably do so too. So bad combinations will include stocks that are in the same sector and high correlation. Let's say, for example, you want to buy 2 stocks, and that's all you want to buy, right? 2 investments. If you buy Woolworths and Coles, okay, together, okay, so they are very, very similar stocks, and you probably don't need exposure to both if that's all you're going to buy. So that's probably a bad combination. Okay? Likewise, for Commonwealth Bank and Westpac, if you're only buying 2 stocks, buying those 2 again, not the wisest, not the wisest. Okay? So better combinations. You want to buy things from different sectors that don't correlate to each other as much. Okay? So things like Woolies and BHP, so mining and a supermarket. Okay? Or maybe you go for Westpac and CSL, the biggest biotech firm on the ASX. Okay? So those would be combinations that would make sense because they don't relate to each other as much. Okay? All right, so take-home point here is that if you decide that you want to buy individual companies on the ASX, make sure you diversify across different sectors. Okay, but there is an easier option to diversify and to reduce risk as well, and that's when we talk about your ETFs, okay, which I'm sure a lot of you are probably quite interested in. We'll focus on ETFs, but before we do that, let's take a break for a couple of minutes. I'm sure everyone's sick of hearing my voice, and I probably need a drink of water as well. So yeah, let's just rest up for like 2 or 3 minutes, and then we'll talk about ETFs. But yeah, let me know if you have any questions. I'll just be here drinking water. So yeah. All right, let's talk about ETFs. Yeah, so good point by iPhone. So Pacific, is that you? I'm pretty sure that, yeah, if you diversify portfolio, yeah, not always better. There are cases, and I'll talk about those cases, but yeah, the likelihood is that you'll be better off, especially in the long term. It's basically a guarantee. Actually, I should never use that word, but yeah, it's if you buy now and then the market doesn't recover in 15 years, there's probably worse thing to be worried about than just your money. Anyway, so talk a bit about charts as well before we jump into ETFs. Okay. So yeah, this is probably not going to be what most of you do, but performing technical analysis using charts can also help with timing your entry and exits to stocks as well. So usually I don't do in-depth analysis, but I look a bit into it, okay, to pick a point to buy. So yeah, chart patterns. Okay, so they typically reflect what people think of the fundamentals. Yeah, so how the stock trades shows you, at what levels people are willing to buy, at what levels people are willing to sell, etc. Okay. But yeah, they can always be wrong as well. If you look at the forums, people arguing about technical analysis, there's always like 2 perspectives, which can be quite challenging. And my tip here, if you do use it, keep it quite simple. Okay, so some examples of charts that I use to for my own investments. Okay, so this is Galaxy Resources. Okay, so they are lithium miner. They're about to merge with another company actually. So you see here in 2018, they peaked and then they were on a downtrend. Okay, so they start not performing well, and that's because lithium prices were very depressed. And when it comes to miners, if the commodity price goes down, then they also earn a lot less money. Okay? So as it goes down, I'm like, I'm starting to notice the company. My dad also, I think my dad bought in, and he gave me a tip as well. But yeah, I started looking into this. I was like, okay, interesting. Lithium, it's gonna be the future. Like it's gonna be used for battery technology. Okay, so around last year, you see here 2020, that was when it hit the bottom. Okay, so lithium was hated. We talked about lithium being loved last week, but lithium was hated last year. Everyone hated it. Look at the forums. Everyone was shorting it. Everyone was saying that lithium is finished, blah, blah, blah. And as we know, that's the time you should buy if you believe in the stock or the commodity in this case. Okay, so I was looking at this and I was like, okay, when can I enter? It's gonna keep crashing, right? And that's when charts can help. Okay, so this is very simple. All I drew is a trend line. But if you look at here, it's been following the trend line the whole way down. Okay, every time it hits the trend line, it crashes back down. Until this point, right? We get to here and then it broke the trend line. It didn't crash, it didn't go on further. It starts to form a bottoming pattern for the next couple of months. I think I bought it at 1.14, so sometime around here. Okay, so I bought it sometime around here. I was like, yeah, it's breaking the trend. I'm gonna buy. All right, so I bought in, and then it went down even more because of COVID. And I was like, oh no, I think at one point I was down like 40%, but I was like, okay, that's fine. I should have bought more then, but I didn't because I was scared. I was scared about, I guess about this stock potentially going bankrupt. So yeah, I was just holding, and sure enough, towards the end of the year, lithium started coming back. Joe Biden was talking about electrical vehicles when he became the president, and that ended up being the push. Governments around the world are now pushing that climate change agenda, and boom, lithium all the way up. Okay, so I think over the last year it went up like 4 or 5 times. You can see here, well, because of the pump last week, it went back down a little bit so far this week, but otherwise it's a clear uptrend. It's doing really well. Okay, so yeah, this is an example of me using the charts to time my buy. Okay, so I ended up buying around here because I saw the breaking trend. There's also ALC. So CDN that we've seen. So that's the stock that I talked about when the directors was buying. Similar case, right? I always liked the company, but it was trading in a downtrend. Okay, so around here, that's when it broke that downtrend. Okay, so I entered around 0.13. It broke the downtrend, and I saw a director buying, and that's why I'm like, okay, I'm gonna buy here. And of course, I was quite lucky with this one. I bought at the bottom, and yeah, it's been up ever since. Okay, recently retraced a bit. I think I sold some like before the peak. Like I saw some around here. But that's another example of your technical analysis doing the job for you. And even though people use complicated methods, in this case, you can just stick to a simple method, just a trend line. Sometimes can tell the story. Cool. Let's jump to ETFs. Okay, so those stock stuff probably not too interesting to a lot of people. And look, ETFs. Okay. ETFs represent a basket of securities and stocks. Okay. All right, so you can trade your ETFs like a stock as well. Okay, so pretty easy. All you have to buy is through the platform, and just like how you buy a stock. Okay? You basically own a bunch of things, a bunch of assets in one transaction. Okay? So for example, there's A200 offered by BetaShares that tracks the performance of the 200 biggest companies on the ASX. Okay, so by buying that, you effectively receive the market returns of ASX 200 in one trade. Okay, so if you recall, ASX returned 11.8% since 1900. Okay, so if A200 existed since then the return would have been close to that. Okay, there'll be like a very small amount of management fees, but it would have meant that you would have gained 11.8% per year, almost. And that's pretty solid, right? And that's probably what most people look for, I'm guessing. It's very low cost as well, 0.07%. So you can take that away from the market return. You can buy that. Okay, so pros of these, you get diversification straight away, easy. You don't have to research too much, you just buy the whole market. And there's a lot of varieties available as well. Some are sector focused, some focus on countries like the Australian one. What are the cons? So it means that you're exposed to the bad companies as well. Yeah, so we talked about how Warren Buffett hates diversification. And that's why, because by diversifying, by buying ETFs, it means that they are holding bad companies as well. Okay? Maybe bad from a share price perspective, and also maybe bad because it's unethical, right? So yeah, and it's also less liquid compared to bigger stocks. When we say less liquid, it would mean that it's hard for you to buy and sell. Okay? So it's not as frequently traded, I suppose. Okay? So yeah, it might be hard to get out or get in at some point. It might be less fun as well if you are into a whole stock picking thing. Right, so more ETFs. Yeah, so probably, I'll just send you the link just to have a look. So marketindex.com.au, and again, this is a really good website that shows you all the ETFs that you can invest in Australia. So I'm going to chuck into the chat box. Don't spend too much on this because already not much time, but yeah, you guys can have a look when you get a chance. And yeah, basically all the ETFs are listed on there. So you can pick the one that suits your boat. So some names of ETFs, providers, Vanguard, BetaShares, BlackRock, iShares, and these are all examples of companies that offer ETFs. You can have exposure to different countries. Okay, so Australia, you can buy VAS A200. US, you can buy BTS. Global, VGS. Asian Tech, for example, you can buy Asia. And these are all things that you can own. You can buy different sectors as well. There's also what we call thematic ETFs. Okay, that allows you to invest into a particular theme that we'll talk about. So these are some examples: QR for biotech, ACDC for batteries, robots for robotics, etc. You can also buy exposure into precious metals. Okay, so things like gold, silver, platinum, you can get exposure to, which I'll talk about coming up, and why I think it's important to have some exposure in those areas. What to look for? You want to look for management fees. Keep that low. Okay. What countries? What kind of sectors do they track? What kind of holdings do they actually hold? Okay, so if you search up the ETF name, right, there should be a website that shows you every single stock that they hold. Okay, it's usually a huge list of things. Yeah, it's pretty easy to find. Some examples. So VAS is a good example. So VAS tracks the performance of Australia's 300 biggest companies. Okay, so instead of 200, you got 300 in this case. Management fees is 0.1%. So if you invest $5,000, you pay $5 in admin fees, which is nothing. Country only covers Australia. But take note that if you buy VAS sector-wise, because the finance and the material sector are the biggest, okay, it also means that a lot of the exposure will be in these sectors. And if these sectors do poorly, then you might not do so well in your returns. Okay. CBA, CSL are the biggest. They're around 7 to 8% of that VAS ETF. Okay. So be really careful. So I guess my tactic here is that if you do buy this ETF, then you want to buy companies that are not in these sectors, so you get other exposures. Cool. Basically changes to CBA or CSL will have a massive impact. Yeah. So who knows? No, I think these are pretty safe, but who knows what could happen. Cool. Another example, DWHF. Okay, so this is a good one. This is the most diversified all equity ETF. Okay, so I think it's the only option out there available for ASX investors. I might be wrong. There might be more newer ones coming in recently, but yeah, this one single ETF gives you exposure all around the world, mostly Australia, US, but you get exposure in other countries as well. Like I forgot the exact percentage, but like Europe, Asia, maybe not Asia, but you basically get all around the world. Okay. Our management fees is slightly higher, 0.19%. So $9.5 is the fee if you invest $5,000. 8,000 securities on more than 60 global exchanges. Okay. Your Vanguard's VDHG. So I have a lot of VDHG. It's a similar ETF, but VDHG has 10% in bonds. Okay, and also slightly higher management fees as well. And bonds is probably not a great holding nowadays. Okay, but it does give you a bit of protection. But it means that you're not all exposed in shares by buying VDHG. So if you only want to buy shares, then DWHF is probably a better option. There's also QR. So number 3 example. So this is something that I have bought into. Bought into this really recently. Today I actually dropped quite a bit, so I'm quite sad. Anyway, so it's a thematic ETF. Okay, so it focuses on biotech within the healthcare sector. Okay, so the country is mostly US. US is where the space is big. So it's mostly US exposure. And management fees is usually quite high in these ones. So if you invest $5,000, the fees are 22.5 per annum. Okay. But yeah, the advantage of this is that it gives you diversified exposure to a sector that you actually believe in, that you think would do well, and that think it fits your ethical goals, perhaps. Okay. So other options out there: ACDC, global, drug tech, etc. Okay, so all these you can look into. All right. Biotech ETFs. Biotech is actually at a pretty good price level at the moment. It's retraced quite a lot from the highs. I think it's like 30% down from the highs. So that's why I made the decision. But biotech is very risky as well. Biotech companies tend to not make too much profits. I think most of the companies in the US biotech space are not making money yet. So that's a risk that you have to be aware of. Okay. All right. So how do you actually get started? Okay, we'll talk about the theory enough. So investment options to consider. Okay. All right, so there's your micro investment apps, which I think would suit the majority of people. Okay. Raise Spaceship are two good ones that I'll talk about. There's also other trading platforms for shares and ETFs. Here are some examples, okay, that you can look into, and I'll talk about a few as well. And yeah, my recommendation is for you to sign up for one fintech app, investment app, so Raise a Spaceship, or maybe both, and also one trading platform that you prefer after you've done your research. Cool. All right, so Raise, this is a fan favorite. It's a great app. Yeah, so it's a fintech micro investment app. Basically shares investments for beginners. Okay, so usually if you are starting off, this is a good choice. Okay, it's quite similar to our ETF in the sense that when you buy Raise, when you put money into Raise, they basically help you to buy a bunch of things. So you get exposure to a lot of markets, and your return probably similar to what you get from an ETF. There's also ethical investment options available as well. You can also choose your own risk appetite. So some of you might be more aggressive. For us young people, usually you want to be aggressive. But if you're a bit older, you probably want to go for a bit more conservative to protect your money. You can also construct your own ETF. Okay, so that's what I do. Within Raise, there's a whole bunch of ETF options that you can select percentage to. But when you put money in, they just help you rebalance automatically. So for example, you say like, hey, I want 10% in Australia. I want 20% in Asia. I want 50% in US. Okay, so they'll always try to keep that percentage. Okay, I think you can buy, yeah, there's like 5% Bitcoin as well that they offer. You can choose not to have that. Okay, so self-constructs. Yeah, so Raise, good or bad, pros and cons. Okay. The pros is that it allows for dollar cost averaging for free. Okay, so every time you buy, right, you can put money in daily. You don't have to pay a single cent. Okay, so ETFs tend to have transaction costs. Okay, when we say dollar cost averaging, we mean just buying at different price points over time. Okay, so you're getting different prices. Okay, you're basically getting an average price over a period of time. Okay, so free to buy and sell. Sell takes a while, I think a couple of days for you to get your money back. There's also rounds and rewards that you can look into. And yeah, most importantly, diversification. And I think even more importantly, it's easy to start. Okay, so you don't need much knowledge. Okay, don't need too much money. But yeah, actually, I'll talk about this point as well. Last sum, you do need some money in it. Otherwise, it's not really worthwhile. Not really worth the fees, which I'll talk about. And not time consuming. You can basically set and forget. Okay, set amount. Set a set amount. Actually, I'll show you my Raise page shortly. But basically set amount. Say I put in $10 per day and just let it roll and forget about it. Cons. What some downsides? Cool. You can't time the market. Okay, so every time you buy, it takes I think a day or two to for the money to roll in. So you can't be like, oh yeah, market's dropping right now and the buy right now. You can't time that. Okay. You can't select individual shares. It's slightly higher management fees compared to the ETFs. And yeah, for small balances, I think this is the point that two notes. Okay, so if you have a very small balance, the fee is $350 every month for accounts under 15K, right? Okay, so what that means is that I think it worked out to be if you invest only $500 for the whole year, you're paying 8.4% per annum. Yeah, so it's not really worth it if you have really, really small balances. You probably want to start off with like at least 1,000 or 2,000 in it. Otherwise, you're paying a lot of fees. That'll probably be higher than your returns. Cool. So be wary about this point. Yeah. Right, so a bit on dollar cost averaging that we talked about. It's a strategy that involves buying at different cost and price points. So effectively, you're reducing your risk of buying at the top, okay, just before the market crash. Okay, so if you buy now, but the market does crash, but if you keep buying, then that means you get the average price instead of the price, just before the top or just before the crash. Okay. But yeah, average price over a period of time, and rates allows for this, which is why it's great. And you can also adjust your daily contribution amounts. So what I typically do is that whenever the market's very, very high, I reduce the amount that I put in. And whenever the market, say, corrects like 5-10%, right, I change my contribution. I might make it, instead of 10, I'll put 40, 50, right? So that means I'm putting more money in at lower price points. Okay, so that's something that I do just based on how the market's doing. Okay. Right, so yeah, that's what I do. But yeah, I think it takes like a day or two for the app to kind of when you put that change in, it takes like a day or two for that change to be active. So you can't like time exactly when you want to buy it. Okay. Right. So yeah, a bit of warning as well. So raise is not magic. So a lot of people tend to think that raise is amazing when they first got into it, but it's not magic. Like all they do is that they offer an efficient service to help you with diversifying and investing in money. That's all it is. Okay? It doesn't guarantee high returns. The market crashes, it's going to crash. Okay. So in 2020 March, it's quite funny. I remember I joined the Raise Facebook page, and so many people were complaining. In March, they were like, "Oh, Raise is crap. You guys are scam. Right? Why you take my money? Where did it all go?" Right? And then I'm just reading those comments. I'm like, "You don't understand a thing," and then you put your money in. So yeah, of course you're losing your money because share market's down. Okay? Only makes sense, right? Yeah, so it's not crap because the portfolio goes down. It's down because share market's not performing well. Yeah. In fact, instead of complaining, when your portfolio is down, you should be buying more on the cheap. Okay, so that's what you should be doing. And yeah, just quickly showing you my Raise profile. So pretty good platform. So this is how it looks like. See a balance here, and then they give you like changing values. And if you look at the invest button, it's all pretty easy. If you want to change, you can also put money in at any point as well. So you can just deposit if you want to buy a whole bunch. Otherwise, there's top ups. I think you can change the portfolio anytime you want. But you see here right now, I'm putting in $40 per day into my Raise. So that's my recurring investment. But that can be changed as well. So I click details, change plan. All I have to do is change this number, and I can adjust how much money I put in. Okay, so it's all pretty straightforward, and I can do this via an app as well. Cool. So usually I just do it on my phone. Cool. Right, and yeah, there's also a referral code. So a bit of I guess promotion. I said no cash, but yeah, there's referral code. So this is mine. If you have a friend or family, use theirs. But otherwise, if you want the $5, then you're welcome to use mine as well. And so that's my code here. I'm just gonna copy that in the chat, but let me know if you don't have access to that after. Yeah, so we get $5 each if you use that code to sign up. Right, what am I doing? Chat. Right, so that's Raise. Okay, and next up, there's Spaceship. Okay, so Spaceship is another platform, quite similar to Raise. You can only contribute weekly though in this case, but they invest in tech. Okay, so their companies are a lot more tech focused, hence the name Spaceship. I think they have like new portfolios recently, but I haven't checked it out yet. I think they've got 3 choices. One of them is the tech focus. I think other ones might have other options as well. Cool. Yeah, so they're tech focused. So Spaceship is doing better, like has been performing better than Raise in recent years. Okay. Right, and no fees up to 5K is a big attraction as well. Okay. So I think last time I checked up is still the case, but if you do sign up, make sure you fact check that whether that's changed. But yeah, as far as I know, no fees up to 5K. Cool. But I think note that just because they perform better doesn't mean that it's a better app. Right? So Spaceship and Raise, they offer the same service, except Spaceship focus on tech. So if tech doesn't do well in the coming year, then Spaceship's going to do worse than Raise. Okay, so be really careful when it comes to that. Yeah, but if you want to invest mostly in tech, innovations, innovative businesses, then Spaceship is a good app to go for. But yeah, be careful. Tech's very expensive. But yeah, I've been saying this for ages. I'm pretty sure last time when I first did the presentation in December 2020, I said the exact same thing. I was like, tech is really expensive, but it's gone up like another 25%. So yeah, there's also a referral code that you can use, and that's the link. Okay, so go drag it across again. Again, yeah, use your friends or family if you have that choice. Cool. Thanks, Maria. Yeah. Some take-home points from this. Yeah, for those that want to start small or prefer some more hands-off approach to investing, Raise and Spatial are perfect for you. Cool. Yeah, even if you're looking for more, I still recommend these apps, mainly because of dollar cost averaging. So I use both myself because I like the dollar cost averaging feature. Okay. Whereas if you buy ETFs, I'll have to be paying fees every time I buy. Cool. Yeah, so yeah, that's the referral code thing. Cool. All right, and brokers. So Raise and Spaceship are two main apps. I think there are other ones out there, but yeah, you guys can research and let me know if you find an even better one. Cool. But yeah, brokers. These guys allow you to buy individual shares and ETFs. Cool. So free to sign up. Yeah, definitely sign up for one. The things to look for: brokerage fees. So how much they actually charge per trade. Some are more expensive than others. Usability. And yeah, also the data provider platforms as well. Yeah, so it's a good app for you to analyze your stocks or ETFs. All right, so CommSec, that is probably the most old school and also the most popular option in Australia. Okay, so I currently use this as well. Okay. The pros of CommSec, it's safe, it's CommBank. Right, it's attached to CommBank. Yeah, if CommBank collapses and you lose your money, I think you're actually protected anyway. There's a separate system that even if CommBank for other reason collapses, you still own the shares. They have real-time trading data, so that's what I love the most. Yeah, sometimes I make I like to play around sometimes. I make day trades, and I need that real-time data to be able to make good decisions. You can also apply for international trading if you like. There's also CommSec Pocket that's similar to Raise, but they charge like $2, I think, per transaction. So it's probably not that great. I don't use it. Cons, they're expensive. It's $20 per trade. Yeah, I'm actually thinking about investigating into other platforms as well that doesn't have that brokerage fees. So every time I buy something, every time you buy something, you have to buy or sell something, you have to pay $20. Right? So that's the downside. Right? SelfWealth, it's not a good one. That I think a lot of beginners might want to look into. Okay, I don't use it, but yeah, basically everyone I've talked to ended up choosing SelfWealth. So yeah, it's cheaper, $10 per trade. I think the first 5 trades is for free. And yeah, you can follow top traders. It's easy to use. It's good for beginners. And yeah, 5 free trades if you use a referral code. Okay, so I do have referral codes. I don't use it myself, but I've got referral codes from my girlfriend, my girlfriend's sister, and my sister. So if you want referral codes to SelfWealth, let me know. I've got them right here. Just send me a private message or ask me on chat later on. Okay, so I've got codes for all those. Cons, yeah, so no real-time data in the free version. I think you've got to pay for live data. So the data is 20 minutes delayed. So that's quite typical, 20 minutes delayed. And that's quite a fair bit. And you can't really make any good trading decisions when you have that delay. Cool. What if you don't have funds to invest? Okay, so this is a risky option, but something that you might want to look into. It's called NAB Equity Builder. Okay, so yeah, they allow you to borrow money to invest. Okay, I think the current rate is 3.75% interest. So if you borrow money, you have to pay the bank 3.75% interest. Okay, yeah, so it's definitely a risk. Okay, so you can get approved. But yeah, the good thing about, I actually applied for this last week and about to get approved, so I'm pretty excited. But yeah, you can get approved and not use the money. Okay, you can get approved first, so that let's say that you get approved for 100,000. You have that money sitting there, and my plan is just to wait. If there's a correction, I'm going to buy in, but if not, I'm not going to buy. Okay, because I think right now it's a bit too risky to be buying shares on borrowed funds. Okay, long term of 3 to 10 years, definitely risky. So if the market goes down over the next 10 years, unlikely, but it's possible. It means you'll lose money and you have to pay the loan off as well. Okay, so very risky. It's a calculated risk that to take, and think carefully and do your research and make sure that you have the cash flow to pay back that loan if you decide to go for this option. Okay. But as long as basically I guess what we're looking for here is that do you think the market's going to go up by more than 3.75% per year? As we see that usually average returns are 11%, right? Okay. I think recently it's a bit less than that. Let's say 8%. If you get 8% return for the next 10 years, the average return, 8% minus 3.75% is the 4.25% that you get. Okay. That goes into your pocket, basically. Okay, so other options. There's also other trading platforms. So Stake, eToro, and Superhero are 3 up-and-coming platforms. Okay, so these are fintech platforms that are constantly evolving. Okay, so the industries, there's a lot of options out there, and these are really cheap. Okay, so Stake, Superhero, eToro, you might have seen ads everywhere. Okay, they're always So I see Talos nodding his head. It's the ads are it's everywhere. Okay. These options allow you to buy international shares. I think Stake, you can buy US shares, and you buy for free. Okay, so some of them offer 0 brokerage fees, not even $10. Okay, I think that's why it attracted a lot of, especially younger investors to go towards it. People that don't have too much money saved up yet. Okay, so definitely worth investigating into. Personally, I haven't looked into this app in detail. I want to, and so I can't tell you too much more at this point. Okay, I think Pacific is still there.
Yeah, I'm here.
Yeah, so Pacific uses Stake, and how do you feel about Stake, Pacific?
I prepared something. I don't know if you can allow me to share.
Wait, you want to share the screen?
Yeah. Yes.
Okay, sure.
Okay. Let's see if I can find it. Oh God. Second.
Got it?
I'm actually using my phone, so I was not home.
That's right.
But I think
tell us about it.
Yes, I can read it because the data, they are really available for everyone. So currently I'm using Stake. So because Stake is very cheap. So when you are trading, so they don't charge you anything. So brokerage fees they don't charge anything, it's 0, and a fee for every trade that you make is 0 as well. So no forex fees per trade, no brokerage fees. So when you want to deposit or withdraw your money, they charge you only 70 base points. Base point is like 0.7%. So if you put like $5,000 today, they're gonna charge you only $35 because you have deposited. So which is like 6%. But other things that you do, they are free there. So you can trade, you can do whatever you want for free. And the other good thing about them, so because we are in Australia, when you move your money from the from bank account, so you have to exchange it because Stake is a like American brokerage app. So you have to change your money in USD, or you can keep it in Australian dollars the way you want. So even the exchange rate, they don't charge anything for exchange. So it's free.
Yeah.
So it is very cheap, and you are exposed to more stocks, ETF, commodities, consumables. So from US, and from next month, they're gonna add stocks, consumers from SCX Australia.
Yeah, same Australian stocks 6 months as well.
Yeah,
Thanks, Pacific. Thanks for the summary. So I think the main point here is that stakes, like a lot of these platforms are trying to cut down the cost for your consumers, for us, which I think is great because people are trying to make it more accessible for people to buy shares. Okay, so good options to look into for sure. Some take-home points as your recommendations. Okay, so you probably want to open a micro investment apps plus one trading platform. Okay, so Ray Spaceship, trading platform, ComSec, SelfWealth, many more that we talked about. Micro investment app good for starting small and dollar cost averaging, but beware of that cost that Race has as well. Trading platform allows for more personalized decisions. So that's the apps part. And now let's talk about portfolio building. Okay, so how do you get portfolio building? So this is how I do it, not financial advice. There's also Swift as well. Thanks, Pacific. So my portfolio actually doesn't look like this at the moment. I'll show you that towards the end. Usually I recommend cash and savings. So usually 5%, and also or however much you need to feel safe, and that's it. Okay. For some of you, it might be greater than 5% if you have a small balance for starting off, which is totally fine. Diversified ETFs or micro investment apps, 60 to 70%. And individual stocks, 10 to 20%. That's the gamble part for those that want to pick their own stocks, and also looking into alternative assets. So things like precious metals and Bitcoin. 15% is slightly towards the high end. I think it's just my bias coming in. But that's what I would be a good portfolio breakdown. Okay, but like I said, I'm doing it slightly differently now. But let's talk about each components. So cash and savings. Okay, so cash is your emergency fund. Okay. Right. So we say cash is trash, but why is this important? Okay, so two main reasons. Right. So emergencies can happen. Maybe you have to pay for surgery, or you lost your job. Okay, all this can happen. So you want to be really careful. Okay. So you apart from emergencies, you also want to have some cash so that if the market does crash, you actually have money to buy into it. Okay. Right? Or maybe a stock that you follow becomes cheap. Maybe something happens and then everyone starts selling and you're like, oh yeah, I love this, I want to buy it. Okay. If you don't have money, you can't buy. But if you have money available, then you can buy these opportunities. Okay. So everyone's different, but in general, you should aim for cash to survive for 6 to 12 months at least. Okay, so that's your emergency fund. Okay. And you don't want to need to sell your long-term investments. Okay, so the worst case is that you run into some emergency, you have to spend like 20K and you don't have that money, and you have to sell your shares. Okay. If the shares are not doing well at that time point, then you end up losing money. Okay, so it's still really important. Okay. And then your ETFs and your micro investment apps. So these are your safer long-term investments. So remember, these can still crash. Okay, so March 2020, GFC, dot-com bubble, all these cases, you can still lose a lot of money. Okay, but these are investments that you don't want to touch for a long, long time. You just want to put your money in and then just hold for a long time. Okay, let the compound interest does its magic. Remember that $500 contribution per month can get you $1 million in 35 years time. Okay, so remember that ASX does return 11.8% for the past 119 years. Okay. Right, so this is another common approach. Right, so VAS and VGS are two ETFs, and funnily enough, I've got a friend that works as a fund manager in Sydney. So it's a pretty high end. I think he's doing pretty well for himself. So a fund manager manages funds, manages people's investments, right? So he has all the goss. He knows what goes on behind the scenes, but he still goes for this approach, which is the most simple approach that it's pretty easy for you to do as well. Okay, so VAS is your Australian ETF. VGS is a global ETF. And you're basically buying both and you decide on a split. Okay, so for example, you decide you want to buy 30% Australia and 70% global. Okay, you can decide how much money you can put in monthly. Okay, top up once a month and you aim to rebalance to achieve that 30-70% balance. Okay, repeat for that for 30 years and you profit. Okay, so that's one simple strategy that you can go with. That's what my fund manager friend does. And he is doing quite well. And I guess the funny thing here is that you would have thought that he would be picking stocks because he knows he knows the business. He has a goals and all that. You would have thought that he would try for it, but he didn't. I asked him why. He was like, "Oh, I just think this is simpler, and it's still a lot of risk for him." Okay, so imagine that. Even for him, he goes for this. Okay, right? For someone that knows the inside outs, he still go for this option. So I think I don't think you're losing out too much if you do go for this option. Okay. Right. So split example. I think effectively this is like it's quite similar to buying into micro investment apps anyway, except the management costs are cheaper. Cool. So you might have 10K to start with. You can contribute $5,000 every 3 months to shares, right? Let's say that's your scenario. Okay. You're aiming for that split. Okay. So at the start, you put 3,000 in VAS and 7,000 in 3GS just to get that 30%, 70% split. After 3 months, let's say hypothetically, that's where the amount split at. Okay. So this can happen. Let's say the global shares did better than Australia. Australia wasn't doing well. Okay, so VGS outperformed. Okay, so current split ends up being 28.9% and 71.09%. So not the 30-70 split that you aim for. Okay, with that $5,000, you can just contribute 1,615 to VAS and then 3,385 to VGS and get back to that split. Yeah, as simple as that. It just requires some Excel work. Every few months. Okay, so your balance now sits at that in that split. Okay. So if it's the other way around, then you end up contributing more to VGS. Okay, but you get my point. It's all pretty straightforward. So that's one option that you can go with for a more hands-off approach. As for individual stocks, so this is where you take your calculated risks. So if you don't like this risk, if you want a hands-off approach, you can allocate nothing. Okay, so that's quite common. A lot of my friends go for that, and I think it's probably smart to do if you don't have that interest or if you don't have the time. Cool. Or maybe you fancy your stock picking skills, in which case you can allocate a higher percentage to this. Okay. So some stocks are riskier than others as well. Okay, so high risk, always high return. Okay, remember, you can diversify across sectors and countries to reduce that risk. Cool. So personally, I think it's worthwhile to allocate some money to try buying stocks. For me, it was very educational. Okay, so when we say doing research, right, usually you don't care as much until you actually put money into something. And once you put money in, you start looking at articles and doing research and learning about the world, and all this can be beneficial for yourself as well, I reckon. Cool. So some type of stocks, usually stocks are classified into 3 categories, broadly speaking. Okay, there's your growth stocks. Okay, so growth stocks are your rapidly expanding companies. They're growing really fast. They tend to be quite innovative, and they're disrupting the market. Okay, so a lot of these don't earn a profit. They don't earn a profit because they're spending a lot of money to grow the business. Okay, if they're not earning a profit, they're not going to pay dividends as well. But some do. Okay, so some good examples on the ASX: Afterpay. So anyone use Afterpay or SitPay? SitPay, Afterpay, anyone? Yeah. Paolo, nothing you said. Yeah. So popular. The younger generation, I used to pay because I bought the stock, so I figured I'll try it. I think it's a pretty cool app. Kogan, Appen, Linus, these are great examples of growth stocks. Okay, so these stocks have huge growth potential, but share price tends to be very, very volatile. I'll show you a chart coming up soon. There's also dividend stocks. Okay, so dividend stocks are more stable, mature companies. They tend to be more old school, right? They stick to the status quo. They have less potential for crazy share price growth over long periods, but these are safer usually. Okay, so we have big 4 banks, BHP, Goodman Group, Dust Group. These are examples of dividend stocks. Okay, so Dust right now pays 9% dividend at the current price. Is it going to stay? Hard to say, but I've got some money in that as well. It's actually looking a little bit risky recently, but we'll see. Defensive stocks. These are the stocks that tend to hold well when the market doesn't do well. Okay, because these stocks are essentials. Okay, so examples like Transurban groups that manage toll roads, Woolies, you have to buy your groceries. CSL, it's always going to be there. These are all more defensive stocks options that protects you from crashes. Okay, so good to have a mix, I reckon. But if you're young, if you want to take risks, I think growth stocks probably have the highest earning potentials. But these are very expensive nowadays, so be a bit careful. SitPay, right? So we say volatile, right? So and by the way, that's the for those that use SitPay, right? That's the new logo. I don't know what they're thinking, but SitPay's new logo is the second diagram here. I'm very confused about this, but anyway, Look at the share price. So the share price over the past 5 years, right? You can see that it's huge fluctuations. it got as high as $14 last year. But you can see here, just early in the year, during the COVID crash, it crashed to below like, it's like $1, $2. Okay, so massive difference. If you can tolerate that volatility, then buy it. But if you think this is too much for you, then you might want to consider your options. Okay, so personally, I hold quite a bit. I think I bought in like around here. But yeah, I've been trading it throughout because it's a good trading stock. But yeah, be really careful when it comes to stock like this. Okay, you don't want to be buying at the highs. If you buy at the highs, then yeah, you'll be panicking right now. Okay. So yeah, that was a stock that was like the lithium last week. I mean, back in February, people were pumping SIP all over the place. I was pumping SIP. I think everyone was excited, but yeah, but that's when you should be avoiding it. Okay. And that's Woolies. You can see here a lot more stable. Okay, it doesn't grow as much as SIP. SIP pay went like, I know, like 10 times, 20 times over the past 5 years, but Woolies doubled. It's still pretty good. So went from $20 to $40 now over the past 5 years. Okay, it's 100% return in 5 years. That's still pretty solid. But you can see here, there's still fluctuations, but it's not nearly as dramatic as SIP. So that's your more defensive stock. You can see here during COVID, it still did reasonably well. It's still a mini crash, but not as dramatic as a lot of those growth stocks. Right, so investing over a life cycle, depending on what age group you are, this should be what you're aiming for. Okay, so I think most of us here are probably in that age group. These are your investment objectives. You want to go for capital gains, take more risks, and you want to focus on growth stocks. Okay, these usually tend to lead to higher gains over the long term. Okay. But like I said, it still depends on when you buy in. If you buy in the wrong times, then yeah, it might take a while until you get your money back. There's also, as you get older, you basically take like less and less risks, and that's when you should look into more lower risk options. Okay. Right, and look for more dividend paying stocks. You want stocks that are stable and pay you a good income so that you have enough money to survive without working during your old ages, apart from your super. Okay. All right, so interesting parts. Moving on to alternative assets now. Okay, I think we are getting close. 20 slides left. Okay. So you see here a picture of gold. Okay. All right, so precious metals, gold, silver, platinum. Okay. These are your alternative assets, and you can also invest in commodities as well, like oil, gas. So not, I mean, these have been doing really well the past year, but I think eventually it'll die out because we are moving to a more renewable world in the future. Can also get exposure to cheese, coffee, orange juice if you like, copper, iron ore, lithium, rare earths, nickel. So I'm pretty big on these renewable metals. Okay, so these are more alternative assets that don't correlate with the market as much. Okay, so cryptocurrencies, Bitcoin, Ethereum, etc. A lot of options out there, but these are the two biggest ones. Okay. So why do you want to invest in alternative assets? Why? Okay. Diversify. Getting back to that D word. Okay. So they tend to be non-correlated to the actual stock market. Okay, so your stocks, they tend to move together. Okay, what that means is that they have high correlations. So if US stock market crashes, the rest of the world will also follow. Okay, everyone lost money in March 2020. Okay, alternative assets tend to have lower correlation to share markets. Okay, so they offer protection in a sense. Okay, if the market does crash, then these tend to perform okay. Like gold last year peaked around July 2020. It's doing really well during that COVID period. Okay. It also protects you from currency devaluation as well. Yeah. And in a way, they are disaster insurance. Okay. So gold and Bitcoin, a lot of people claim that they are the actual real sound money, not fiat money that government can print whatever they want. So case of gold. Okay, so gold and silver applies to this as well. I remember inflation and currency devaluation that we talked about. Okay, so gold historically is seen as your real sound money. Okay, that offers a storage of value. Bitcoin is also starting to show some similar characteristics, but Bitcoin is very, very volatile at the moment. You can lose 50% of your money in a matter of like a couple of weeks, so be really careful. Bitcoin is still finding its place, I suppose, as an asset. So definitely be really careful with Bitcoin. Gold is priced in dollars. Okay, so dollars is your currency, right? It's not gold going up. So gold maintains its value, right? Gold's value doesn't change. But currencies are going down in value because there's constant money printing. Right? And since gold is priced in dollars, that means the value of gold in dollars terms are going up over time. Okay. Right. And yeah, gold is going to go up over time in dollar terms because of that, in some ways, irresponsible printing by the central banks and your governments. Cool. In case for Bitcoin, okay, so this one's an interesting one, very controversial. I'm sure some of you are probably shaking your head, kind of like, why are we in this? Why Bitcoin? Okay, so Bitcoin is also called the digital gold, been known as that. Some people hate it, some people love it. Usually you get two ends of the spectrum. What you need to know about Bitcoin, it has a fixed supply at 21 million. Okay, it's a fixed supply. Okay, so supply doesn't go up and demand goes up, that means the value is going to go up. Okay, so that's very attractive. Gold, on the other hand, gold can actually increase in supply because if you have gold, in order to have more gold, you just need to mine it, right? Okay, so gold doesn't have that fixed supply element. And unlike gold, you can also transact with Bitcoin. Okay? Bitcoin, I think Jack Dorsey called it internet money. It's also decentralized. Okay? So government does not control Bitcoin. Okay? We've talked about the issues of money printing and all that. No, they can't do that to Bitcoin. Bitcoin is fixed at 21 million. Okay? Also has a potential to make the world a much fairer place. Okay? Because what it does is that if you transact with Bitcoin, right, it removes all the third-party costs. Okay, right now we're paying via bank systems. Okay? I know most of the transactions are free, but then in some cases, the middleman, the third party, might charge costs. Okay? But Bitcoin removes that. Okay? Especially important for people in developing countries. Okay? So they tend to pay ridiculous fees in transactions, and that can create removing that can create economic freedom for them. And that's how they can prosper, right? So it took me a long time to kind of buy into Bitcoin. So I didn't really believe this when I first heard of it. I was like, this sounds like a scam. Okay? But the turning point for me, one of the turning points for me was it's actually a couple of months ago, or maybe a couple of weeks ago. Yeah. So it's a conversation with a student, right? So I've got a student that studies in Kenya. Okay, so she's doing long distance study over in Kenya. Okay. And she wanted to buy a textbook for law, I think. And the textbook cost around $100 Australian dollars. Okay. She ended up having to pay $500 for that textbook in total. So instead of paying 100, she paid 500, 5 times that amount. Okay. And why? It's because in between, there's all this like bullshit third-party transaction costs involved in bringing the book to Kenya, and also the transaction cost. Like government wants some money and all that stuff. Right? It means that she ends up, paying a lot more for that book. Right? It's not fair to her. It's crap. Like Kenya is already not a very financially wealthy country, and yet she has to go through that. Okay? Bitcoin will solve that issue. Imagine that she can transact with Bitcoin. Just buy Bitcoin, like using Bitcoin, just pay for that textbook, and that's it. And you still pay for transaction costs on the way, but it'll be a lot less than just 100. Okay? Right? She liked the hard copy. Yeah. So is that what you're referring to? Like, yeah. She just wanted a hard copy. I suppose like she's probably pretty wealthy over there, but still, like she was complaining a bit, just like it's unfair. Cool. So important. And this is also a turning point as well. It didn't used to be backed by institutions, but now it's backed by a lot of companies, a lot of investment companies. I think what's his name? His name's Michael Saylor or something. He bought into it last year. He was probably one of the first guys that was really pushing for it. And then Elon Musk, Jack Dorsey, Cathie Wood, Lynn Alden, all these people are backing Bitcoin. So all these are big names in the economics and also in the world, okay? in the whole finance world. Okay? If they're backing it, if they're using it, it's probably going to become reality at some point. And there's also a country, I think someone mentioned via direct message that El Salvador is also using it. All right, so this is a quote from Jack Dorsey, the CEO of Twitter and also Square. He sees Bitcoin as a push towards economic freedom, okay? And that's gonna be pushing innovation around the globe as well and making the world a fairer place. Okay? If you believe in making the world a fairer place, I think Bitcoin is probably something that you want to look into. I'm pretty sure there's like other side of the arguments for, but you guys can have a read of that and come to your own decision, I suppose. That's the quote from Jack Dorsey. Another quote: "The world ultimately will have a single currency, and the internet will have a single currency," and he believes that is Bitcoin. Okay, so that's what he believes. And then that's Elon Musk. Elon Musk is full of crap sometimes on Twitter. Follow him, he's funny. Bitcoin is almost as BS as fiat money. So a lot of people took that quote as like, so fiat money is like your currencies, right? A lot of people took that quote as him saying that Bitcoin's bad, but he's actually, he's a troll. So when he say the keyword here is almost. When he say almost, he means that he prefers Bitcoin over fiat money. Good point by Laura as well. Environmental impact of Bitcoin. So so I think that's a really good point. I think that's an issue that they are trying to resolve as we go as well. So that's definitely something to look out for. Personally, I don't understand I don't really understand the tech behind it. So I can't comment too much on that. But so I know that's something that's definitely an impact that they have acknowledged. And I think things are probably going behind the scenes to address that. But we'll see how that goes. Cool. It's funny how Elon says that. Anyway, but more reason why I should be buying some gold or some Bitcoin. Okay, one or the other. Cool. So stock market, very overvalued by traditional metrics. So on the right in the graph here, basically it's called a buffer indicator. It shows the ratio of the value of stocks / GDP. Okay, so GDP is the gross domestic product, basically how much value economy produces every year, right? So valuation, it's a rough measure of stock market valuation compared to size of the economy. Okay. So note that, so looking at this year, around this point here, that's the dot-com bubble. Okay, so 2000 is when we had that crash. And you see here, it's away from that historical trend line. Okay, so we had that crash and went back down towards below the trend line. Okay, you can see here, it's ridiculous. Okay, so August 12, 2021, 238%. Right, so it's ridiculously high. And a lot of people are speculating that this is going to go back to the trend line eventually, or maybe even below it. If that is to happen, it means that your stocks probably crash a lot. Right? You'll be losing like 50%, 60% of your money in the stock market. If that is to happen. All right. So can it crash? Absolutely. Can the bubble keep inflating? Can this keep going up? Absolutely too. No one really knows for sure. It's really hard to say. And like I said, money printing is quite a recent strategy. Right? It wasn't implemented back then. It is now. So maybe things can keep going. Cool. And more reasons why I should buy this. Governments around the world are full of debt. Okay, so money printing can't stop. So that your debts can be paid back. Okay, so that debts can actually be paid back eventually. Right, so that's my base case. A lot of people saying that debts have to come down. I don't think so. Debts, governments don't really owe anyone. I think their strategy right now is just to push the debt and just keep on going and keep on pushing this higher and higher. Okay, so that's my prediction, that debts is probably just going to keep on going up. Okay, and it means that interest rate must stay low to reduce the cost of debt. Okay, so the reason why I say interest rate can't go up is because interest rate if the interest rate goes up, the debt becomes more expensive as well. When you owe someone's money, it's owed by interest rate. So if the interest rate is high, you got to pay back more. The government's not going to want to pay back even more money. And that means interest rates probably stay low for a very long time. Cool. And these conditions tend to be quite ideal for gold and Bitcoin. Cool. Cool. Thanks, Steve. Luke, good point. I'll talk about that. Yeah, I will cover that coming up very shortly. Cool. Just one more slide on the case for gold and Bitcoin. Right, so I'm trying to warn you of the risk of the stock market, I suppose. Like, this is the main point. Okay, so remember someone made a comment that in 10 years you'll guarantee you probably guarantee a good return, right? Cool. Let's look at this chart here. Okay, so this is from Lynn Alden's article. The blue line here represents the households holding equity. Okay, so that blue line basically represents how invested regular people are. Okay, right. So how many people are actually buying stocks, are investing in the stock market? Okay, right. So orange bar represents the yearly return over the next decade. Okay, so for example, it's only up to 2011 because we only have data up to that. So 2011, this bar here represents 15%. So it's saying that over the next 10 years, from 2011 onwards, from 2011 to 2021, you can expect that people have earned 15% return in the stock market. Okay, if you invest in 2011. Okay, but take note that there are negative years, and there are years where you get negative returns as well, and namely here. Cool. And note the inverse correlation between the blue line and the orange graph. Okay, so when that blue line peaked in 2000, that's when the dot-com bubble happened. And what happened over the next 10 years? Right? If you invested money, 1999, 2000, you had negative returns over the next 10 years. If the money you put in then, you would have lost. Okay. If you held on 15, 20 years, you still would have gained back. But the point here is that if you enter the market then and stop buying when the market crash, yeah, you would have had negative return. Okay, that's not something you want. Okay, and if you look at the blue line, we are again currently peaking in the equity exposure. You can see here we are peaking again. Right. So in fact, we are way beyond that point. Right. So if the inverse trend on this chart holds, then you probably expect poor returns over the next 10 years. We might get another 2000. Okay, that could happen. But things are different nowadays. Okay, there's a couple of reasons why things might be different. Okay. So first of all, investing is a lot more accessible. Okay, it makes it easier for regular people to get exposure in the markets. Okay, anyone can just jump on the phone and buy stocks. It's easy. Right. People are also better educated to buy the dips. Okay, so I think most people, back then they'd be like, "Oh no, I'm losing money, sell." But I think most people nowadays, and they still have an effect, but most people nowadays trust the system a bit better, and they are willing to buy in when the market drops. And if everyone's buying once the market drops, right, markets will keep staying elevated, right? Right. And of course, finally, there's also the money printing strategy by the authorities. Okay, so it wasn't present in 2000s, and nowadays we are going full money printing mode, basically. Cool. Yeah, so having said all that, it's important for us to be cautious, and that's why we want to hold some precious metals or Bitcoin, where we can hedge against potential poor returns in the markets. And do that via alternate assets. Cool. Right. All right, so I pumped a lot of Bitcoin and gold, but there's also cases against it. Okay. Right, so why not gold? Gold, when you think about it, has no real use. Okay, traditionally, people see gold as money, but gold is worthless. Like, what do you do with gold? You just store it and you show off, like, oh, I have a lot of gold, I'm cool. That's all you can do, right? It has no real use when you think about it. Okay, so no intrinsic value, I think is the phrase. Okay, and also Bitcoin is taking over gold in recent times. Okay, a lot of the new generations prefer the digital version. All right, so gold has actually done very poorly over the past year. It peaked in July 2020. Ever since then, it's been going down. But like we said, I think going down means that it's good time to buy. But the reason why it's going down despite the high debt is because people rather buy Bitcoin. Okay, there's no way around it. So there's a bit of shift there in perspectives. Gold mining as well, it's not ideal for the environment. Okay, so you got to be really careful. Yeah, gold mining in general is probably not great. So yeah, and yeah, I think that's an agenda that's something that we probably want to avoid going forward in the future. Gold also takes up a lot of storage space. Okay, if you own gold, if you own physical gold, right, it's a nightmare to store. You got to find space at home. It can be stolen, all kinds of stuff. Cool. Then why not Bitcoin? Okay, so as Laura mentioned on the chat, she mentioned about the environmental impacts. So yeah, I think recently Tesla stopped allowing Bitcoin to. I think Tesla last year they approved Bitcoin for transaction. You can buy Tesla with Bitcoin because Elon Musk said so. But a couple of months ago, he flipped his decision. He's like, oh yeah, we're not accepting Bitcoin anymore because of the environmental concerns. Okay, so there is an element of that as well. And yeah, I probably don't know enough to comment on that further. Yeah. But yeah, read into that. Yeah. Apart from that environmental impacts, there's also other smaller cryptocurrencies that might take over eventually. There's also government regulations. So governments want control. Right now, they've got no control over Bitcoin. Okay, but we know governments, they like to control people, and yeah, eventually they might find a way to regulate the coin. Yeah, it also can be quite confusing for a lot of people as well to use, and that might put off Bitcoin being, a proper tool for transactions. Cool. All right, so how do you gain exposure? So Luke, I think this answers your question. How do you gain exposure to precious metals in crypto? So first of all, precious metals. The best way is to buy physical. So you can buy it and store it at your home. or you don't want to, this is what I do. I buy physical gold and silver. I have some physical silver through Perth Mints. Okay, so Perth Mints, like they have like a whole vault in Perth. I assume that stores in gold and silver. Bear in mind, I've never actually seen my silver, but yeah. So at least they claim that it's stored there. I think a lot of people are doubting that, but this tends to be the safest. Okay, so there's an online platform. You can ask me more about it afterwards if you'd like. Perfmint.com, they store your silver there. Otherwise, if you prefer a more liquid option, there's also ETFs like paper gold that you can buy. Yeah, so you're supposed to get gold and silver exposure through this. So if the price fluctuates, the price goes up or goes down, these ETFs expose you to that price change. But these can be unsafe if things collapse. If we really get to the nightmare scenario where everything crashes, then if you own paper gold, the likelihood of you getting the real gold is probably not going to be very high. So this can be unsafe if we do collapse. You can also own gold silver miners. So this way you're exposed to leverage growth. So whenever gold price goes up, the miners usually double or triple the return. Okay, but likewise, on the way down, if gold goes down, then these miners tend to struggle. Cool. So these are ways to get exposure to precious metals. Cryptocurrencies. So there's a lot of trading platforms out there, a lot of options. I'm not expert on this. I kind of recently just started buying to the dip. These are some options that I know of. Binance, Crypto.com, Coinbase, CoinSpot, Celsius. I've got Binance, Crypto.com, and Celsius accounts. I don't know why I started that many. I guess I just want to like investigate into this. There's also Bamboo that offers dollar cost averaging into cryptocurrencies. But yeah, when it comes to crypto, all these platforms you can get exposure to. I think technically you own them, but then the safest option is to store it cold. So most serious investors in crypto, they I think they buy like some kind of yeah, someone can correct me here. I can't remember what it was, but it's kind of like USB stick where they can transfer Bitcoin into that stick. And yeah, once it's transferred, you just keep it in a safe place. And I think there's like a password that only you should only be the only one that knows the password, and no one else can access it. Cool. Yeah, so instead of like storing gold in your house, you're storing Bitcoin in a USB kind of. And that's yeah, supposed to be the safest option, because once again, if these exchanges collapses, then your money is also at risk. Yeah. Oh well. So everyone look at Radi's comment. This is crazy. Yeah, sounds about right. So yeah, if you bought Bitcoin back then, yeah, you would have the Bitcoin started in 2008, like yeah, somewhere around there, like yeah. But yeah, Bitcoin was like trading at like below $1 when it first started. And yeah, it's like 40K now, USD, 60K in Australian dollars. So 6 house in Belmont. Yeah, sounds about right. It's crazy. It's good on it looks like he held into the Bitcoin as well. I think a lot of people would have sold, seeing it go up 10 times, 100 times, but it just kept on going. But yeah, these platforms, if you want to look into it, I've got referral codes as well. So just let me know. Cool. And an image to yeah, so let this sink in, I suppose. Bitcoin, very volatile. It was trading, I think it peaked at around 64K USD a couple of months ago. Okay, so that's when the internet was going crazy. Everyone was talking about Bitcoin, buy. Okay, you see a lot of people are waiting for this, and it crashed back down to 33K, 30K-ish mark about I think it bottomed around like 3-4 weeks ago, something like that. But yeah, everyone was fearing. Okay, but you can see that change. Like if you bought in 64K, you would have lost like 50% of your money within 2 months or so. Okay, so very volatile asset. Yeah, so luckily for me, I actually bought in around that mark. Yeah, that was my first exposure to Bitcoin at around that 30K mark. So now it's back up to 47K-ish, but it can still go back down. Who knows? Yeah, the way I see it, I think it goes to zero, or it goes up another 100 times. Most likely that's what's going to happen. All right, so yeah, take home points. Your alternative assets like gold and Bitcoin tend to do really well in the current environment. We have negative real interest rates, which means that yeah, people would rather own gold and Bitcoin than own cash, because you're losing value in cash. Currency devaluation, these are all concerns. It provides a protection against inflation and low interest rates. Right, so it's meant to be protector from all these things. and also protection in case the financial system collapses. Right? This might sound very far-fetched, but if you look at the history of fiat currencies, look at the history of governments managing money, it's never worked out in the long term. Okay, so nowadays the authorities are going crazy with money printing and the modern monetary theory. Maybe it'll work. I don't know. I don't think there's enough. People argue for both sides. It's hard to say, but you need to be really careful. Okay, so yeah, they're definitely playing fire, and that's why you want to own some alternative assets to protect against that scenario. Yeah, who knows when that will happen? Maybe not in our lifetime. Hard to say. Okay. Yeah, so Bitcoin has potential use to make the world a better place as well, and yeah, definitely note the risks that's involved with these assets. Okay. All right, so yeah, we are close to wrapping up. My portfolio as of yesterday. So this is how my portfolio looks like. These are my, yeah, this is what I own currently. Okay, so yeah, so it's a very diversified portfolio. I'm actually not, I think I'm too diversified. I think I have too many things. And it's kind of doing my head in. I think I should be reducing this, but yeah, so this is where my money's at. Okay, it's probably a little bit high. I think with my precious metals and cryptocurrencies, I have 20% allocated to it. I think that's a bit too high. Yeah, but at the same time, I am very wary of the current stock market valuation. That's why I have a higher percentage in these assets, and my cash is also 15%. You notice that's also a little bit high as well. Cool. But yeah, a lot of my money mostly in ETFs. So these are diversified ETFs, Embrace, Vanguard, etc. And then I've also got Asia, the QR Biotech ETF, the Hack cybersecurity ETF. Yeah. And then also random individual companies. A big thing that I look at is the renewable commodities. Yeah, so I've got exposure to rare earths, lithium, nickel, and graphite as well. So I think that's where a lot of my, I suppose, gamble is towards. Cool. Yeah, so I think it's good to be honest about what I have as well. Cool. All right, so what am I currently doing? My portfolio. So right now I'm dollar cost averaging $40 per day into race and 125 in the spaceship. So that's so this amount is weekly. So per day is $40, per week is 125. Not that rich. And my recent buys over the past month or so, Bitcoin finally got in. I also bought in some Ethereum. I bought some biotech because that's been retracing. I bought some Transurban because it's a defensive stock. And like I said, I'm a bit worried about the market being too high. Added the Dust Group because it's dropped recently, and I think at 9% dividend yield, it's pretty attractive. But note that with Dust Group, recently someone big sold as well. So one of the institutions sold Dust Group, and I can't help but think, did they sell because they know something that I don't? Maybe Dust Group did not perform so well in the recent report. Hard to say. Added Asia because it dropped, and also added Telga Group and bought Taro Payments as well. That's my recent actions. Also sold some stuff. I sold some lithium. I sold too early. I sold like 2 weeks ago when before the pump. But yes, I thought I had too much lithium, so I sold some down. And also TNT, a cybersecurity company that was a bit of a gamble. Short-term plans for me, money-wise, I want to add a bit more defensive options to protect my money. And I want to buy the dip if tech drops, if renewable commodities drop, if Bitcoin drops, I'm gonna buy a bit more. And that's my plan for the next couple of months, I suppose. Cool. All right. So mistakes. Gonna be honest with the mistakes that I've made as well. So some big mistakes. Okay, so I've bought 3 stocks that went to zero. Okay, so these are solid like 5K investments. So I guess that tells the story. So yeah, so far 3 stocks I've gambled on went to zero. So it definitely happened. Well, not exactly zero, but they're worth like $2. It's not even worth mentioning. They're basically bankrupt. Okay. I'm also very prone to FOMO. I had gold before July, but then when it peaked, I was like, oh yeah, I was like all pumped. I was like, it's gonna go even more. So I bought a lot of gold, and when silver pumped in Feb, I did the same. It's a bit silly of me, to be fair, and that has not done well for my portfolio. Okay. I also have bought ETFs at peaks as well. Like I said at the start, I also lost 2K in day trade earlier this year because I took a bit of a gamble, and then I was like, that's too much. I need to stop. Yep. So all these mistakes I've made. Yep. And that's why don't take any recommendation from me as gospel, because what I said or what I own even, I'm not guaranteed to do well at all. So do your own research. Okay. So a lot of the stocks that I just showed you, some of them might go to zero. Happens. But yeah, despite all this, it still be very generous. So overall, yeah, so last financial year, my passive income was from investing alone was more than double my yearly expenses. And so I've spent quite a long time on this, but yeah, it's definitely possible. So that's including my mortgage repayments. Yeah, what I earned from stocks was double that. So I'm pretty happy. But obviously last year was a very good year when it comes to investments. So not every year is going to be like that. Yeah. But as your balance grows, as you have more money in, you don't have to earn it. Let's say if you have like 2 million in the market, right? One day if you get 2 million in the market, like 20 years later, maybe. And all you have to do is earn like what? If you get like 8% of that, that's already 160K. So that's right, something like that. Yeah, 160K of passive income, right? So it's about gradually building to that stage where you can comfortably say like, hey, passive income is enough for me to sustain my lifestyle. And that's when you can, choose things that you want to do and enjoy life and retire, and do things that you actually want to do instead of working for money. Cool. Yeah, so with enough time in the market, yeah, you can definitely build a solid portfolio as well. That can generate passive income to help you live a better life. Or maybe you're very ambitious, you want to really change the world. Hey, that's your worldview, then like Chamath said at the start, push for it. Okay, so earn money and then push for that worldview, whatever it may be. Like that's the point of the world is a game of opinions, and you allocate the money to things that you believe in. Okay. Right. So yeah, some stuff that you may not be doing. This is just like random tips when it comes to money. So I think we've talked about this already. Look for high interest saving accounts. Sticking with the big banks are usually not a great idea. So they usually offer very low. Except Westpac, they have 3% for 30K up for people up under 30. Okay, so look into this. Definitely very attractive. And the second thing, I think this is probably something that you might not be aware of. Anyone look at this super? Anyone looks at this super at all for those that are working? Yes, no, maybe. Yeah, so superannuation. It's a big thing. Do you know what they do to your super? Like the super money? Like what actually happens to your super money? Anyone know?
They invest it.
Yeah. They invest it. They just buy shares. They just use it to buy shares. And I think you can adjust the option. You can see like if you see like a high growth, 100% growth, then it's just all in shares basically. All right. So yeah, that's what they're doing with super. And by contributing to your super, you're actually just buying shares in some ways. You're buying ETFs by a super account in a lot of ways, right? And there's a law, right? You can contribute up to 27.5K into your super every year. Okay? For Australian citizens. Yeah. That's taxed at 15%. Right. So this amount of money, you can contribute up to this much. I think your employer contributes already, but there's usually a gap unless you earn ridiculous amounts of money. Maybe some of you are, but for most people, you probably wouldn't get up to that cap just by relying on your employers. Okay? So what I do normally is that like I know my yearly income, and towards the end of the year, I would chuck in a bunch of money just to meet that 27.5K. It used to be 25K, but now they upgraded. And that money is only taxed at 50%. Okay. So as long as you're earning above 18K, it's worthwhile for you to contribute. As long as you're earning above 18K, it's worthwhile to contribute to try and max out that concessional contribution. Because when it comes to taxes, every dollar earned above 18K is 19%, and above 45K, 32.5%, above 120K, 37%, etc. Okay, so which means the difference in tax rate is what you save. Okay, by doing a concessional contribution. Okay, so this is a huge tip. I think will save you a lot of money going forwards. Yeah. So definitely look out for that if you're not doing that already. So putting everything together, to summarize, no one understands the risks when it comes to investing. Yeah. So again, some people have done really well gambling in one stock. There's one like influencer that I follow. He's like all gambling on Tesla. I think he bought Tesla in like way before the pump, and then he's just like, oh, Tesla is the future, blah, blah, blah. And that's all he owns. I mean, it's like 90% Tesla. He's doing really well. Yeah. But yeah, nothing wrong with that, but understand your risks. Tesla was close to bankruptcy. So if it went the bankrupt direction is instead of the the pump direction, then it could have gone the other way. But it's Elon Musk, it's probably going to be okay, but it's always risky if you gamble on one stock. Okay. Yeah, can absolutely lose money in the short term. Manage your risk for long-term success, and you can also start your investment journey by registering for the following options: raise a spaceship, micro investment apps, trading platforms that we talked about. Yeah, but remember, diversification is key, especially for us, retail investors, and that's really important to note. And finally, think long term as well. Okay, so this is quote: "Time the market, not timing the market." Yeah, I think timing the market could work very well for some people if you get the timing right. But in general, yeah, it's risky. It requires a lot of focus and attention that most of us probably don't have time for. So time is the market is probably the way to go for most people. And yeah, some useful resources for you to do further research on. You can look at websites. Marketindex.com.au that I showed you is pretty good. Tradingview.com, I like that. So all the charts that I've done, it's via tradingview.com. So if you want to look at short-term trading or use technical analysis to help guide your decisions, then look into that. Strawman.com also quite like. I think they you have to pay now. It used to be free, but yeah, they provide like fundamental analysis on companies that I think are pretty solid. Investopedia.com, it's like the Wikipedia of investing. Yeah, it's for general FAQs. I think it's really helpful. Some podcasts and people that I recommend if you want to do more further research. Equity Mates for Investing. Okay, if you want to buy ASX stocks, especially, these guys are very good. It's just two guys that are interested in equity and they're mates, and they start a podcast basically. But they're really, really good. Search them up. Australia focused and easy to understand for people that don't have that background. Lynn Alden, so I've referenced her several times. She's really good at analyzing stuff on the economy. Chamath is the guy from the start that talked about money. Okay, he's for me, I think he can be controversial as well because he's very outspoken. But for me, he's honest. He's not corrupted, and he invests for the future as well. Okay, yeah, it's also a big proponent of Bitcoin, and they have a podcast together. So Chamath, Jason, Sachs, and Freeberg, these four guys, yeah, they've got a podcast called In Podcast that they do weekly. Yeah, to me, they provide a lot of excellent nuanced views. Nowadays, when we read news on the media, usually it's like too extreme. It seems to be like the right and the left, like liberal or labor. It's always like two extremes trying to battle against each other, right? But these four guys, I feel like they combine both. They provide nuanced views on things, on what is happening in the world. I like to hear those views because, yeah, I think things are a lot more than just two sides when it comes to politics and stuff. Cool. The Spinach Shift, so it's a funny one. He's actually he's anti-Bitcoin. He loves gold. He's very controversial. I don't agree with everything he says, but I do think he has good insights to economics. He's also very much a capitalist. I hate regulations. So yeah, for some people it might be a bit extreme, but I do think he offers some interesting viewpoints from that capitalist perspective. Okay. But yeah, like I said, I don't agree with everything he says. Yeah. And Facebook groups, it's like 5 discussion groups. Saving Investors is a good group that I follow. Raise Investors. There's Reddit. So funny enough, Reddit actually has a lot of good sources. Oz Finance, Financial Independence, and these two are more of a joke ones. Wall Street Bets and ASX Bets. You might have heard of that in media. The GameStop thing was generated by Wall Street Bets early this year. The whole GameStop saga going crazy. Yeah, so even though they are a bit of a joke, some of the posts actually has really good analysis on companies on the macro environment. So there are people within that know stuff. You just have to be able to decipher yeah, whether it's good information or not. So these are, yeah, firms I recommend. And finally, yeah, I should start a Facebook group. Last time I did this, but I never followed up. But the group is here. So if anyone wants to join and talk about investments, I'm going to share the link here. So welcome to yeah, join and ask about investment options, so we can follow up on this conversation. Okay, so that's the group. Yeah. So that's on the chat right now. If you're interested in joining and talking more about investments, then yeah, join the group and I'll accept you. Okay. I think that's it. All right. So yeah, hopefully this is an interesting and life-changing presentation for those that have not started investments, especially. And yeah, hopefully the future is bright when it comes to your investing journey. Right. So thanks everyone. We are at 9 p.m. So 3 hours. I'm actually proud of that. I thought maybe a lot longer. But yeah, thanks everyone. Hopefully that was informative. Yeah, so I still got some time. So if you want to stay behind and have a chat about general things, you're welcome to do so. Or ask any investment questions. Whichever. Thanks everyone.
Thanks. It was good to see you. Thank you for that.
Thanks, buddy. Okay, good to see you too.
Thank you, Hans, for putting this together.
Wait a sec.
Love you.
Hey, Tak.